Good morning, everyone. It's Thursday, January 5th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Brian Sazi. Here's what you need to know as the clock hits 9 a.m. Bed Bath & Beyond warns that things will get worse. Shares of the company plummeting this morning after the company said it's headed for major financial troubles. We've got the details in just a moment.
Plus, trouble in tech as well. Amazon announcing the largest amount of layoffs in the company's history, becoming just the latest company to shed workers after a year of aggressive hiring.
In a House divided, the lower chamber of Congress at standstill after another failed speaker vote. Kevin McCarthy vows to fight on, but his opponents in the GOP seem just as resilient. We'll bring you the latest on the D.C. drama. But of course, I'll begin today with a market check. Julie, over to you. Lots of things moving, markets, you name it.
Yeah, and we've got a plunge in the futures that was happening after we got the ADP jobs reading earlier this morning, coming out with a gain of 235,000 versus the 150,000 that economists had been anticipating, and also an upward revision for the prior month. Now, remember, we get the big government jobs report tomorrow, and that's really the one that the markets key off of. Indeed, there was a little bit of caution this morning being expressed that ADP doesn't always line up with the government jobs report. Of course, the concern here is that with the job market still expanding at this pace, it's going to make the Fed's job even harder, might have to put its foot on the gas pedal even more, especially emphasized after the Fed minutes yesterday seemed to express concern on the part of Fed participants that the market is not going down enough, not tightening financial conditions enough. So you see futures down this morning. Nasdaq futures down even more, as you might expect. They tend to be more rate sensitive. And of course, we've got Treasury futures going lower. That means rates are going higher, reflecting this perception about the Fed. Here's the 10-year note. We're seeing that at 3.75%. And then a quick check as well as to what's going on with some of those large cap tech stocks in particular. Here you see below some of the pre-market moves that we've got here in some of these stocks, and most of them are downward sauce.
All right, let's stick on those downward vibes. Bed Bath & Beyond shares are plummeting as the company warns of deeper financial troubles ahead. In a business update it put out this morning, the company emphasized its net loss over $385 million for the fiscal third quarter of last year and says it's considering options, including obtaining bankruptcy relief. So let me just not bury the lead here and just start off with this. Why are you seeing the stock down 20% in the pre-market? Company notes two things. It sees substantial doubt about the company's ability to continue as a going concern. Anytime you see struggling companies put this line in a statement, usually they do not include the word substantial. So just the fact Bed Bath & Beyond put that in there is very telling and a massive red flag. Number two, as you just mentioned, they did not rule out filing for potential bankruptcy. So put these two together and you have a retailer after a very bad holiday season. I will run through the numbers here, suggesting it may not make it to the holiday season of this year, as Loop Capital Anthony Chicumba came on our network last week and told us might happen. This is a company essentially saying it may no longer stay in business. But again, a very ugly quarter for Bed Bath.
Yeah, in this business update, they also gave us some insights into the financials. And this coming off of what was an extremely challenging quarter, one where Sue Gov actually noted within that update that despite some of their more productive merchandise plans, improved execution, financial performance negatively impacted by inventory constraints. And then they also continued to have to weather, like much of the market, especially in retail, some of the micro and macroeconomic challenges, had reduced credit limits as well, which impacted their ability on the inventory front too. But then just thinking through the financials of it all, net sales, they're expecting to report that coming in at approximately $1.259 billion. That's compared to the $1.878 billion in the same year ago period. And so that just adding on to what you laid out in the fact that they added that very serious sentence at the end of that bankruptcy nod saying these measures may not be successful.
Also delaying the release of their 10Q. Now, I reached out to Bed Bath & Beyond to get the amount of cash they had coming out of the quarter. They did not return my request for comment on that, but seeing how much the cash they had exiting this quarter is very important. It will help determine if there is some form of path forward for this company to stay in business. Again, that number not there is a red flag. And then also a red flag, as we talked about, I believe, earlier in the week, they were unable to convert a lot of debt holders. They were trying to do a debt conversion. Not a lot of debt holders submitted papers or wanted to turn their debt into various other options to help Bed Bath survive. That's a huge problem. Huge problem.
Right, and let's just remind people that just because a company is filing for bankruptcy, which the company is not yet saying it is, but even if it does, doesn't mean Bed Bath & Beyond is going away, right?
Correct.
It doesn't mean it's closing its doors and that's it, it's done. It rather allows the company potentially under a different structure to restructure, to try to right the ship. And that's what Sue Gov sort of seems to point to in this statement. She says we have a clear vision for the company. She talks about what they want to do. Firstly, refocusing merchandising and inventory, cutting costs, operate more efficiently. And she says, secondly, to focus on strengthening the financial position. So it might be that the company comes to the conclusion that it can only achieve those goals or best achieve those goals through a bankruptcy filing.
Well, now Bed Bath has essentially entered the black vortex of retailers, and I've seen this playbook happen before. Sears, Linens and Things, Circuit City. Usually you will see pretty much the same release that Bed Bath put out today. Next steps you will likely see. No, you're not going to see a lot of discounted products in the stores, or to your point, Julie, going out of business sales. But what you will see is even less inventory availability in a retailer, and the shelves in the store are likely to get increasingly empty because suppliers are worried about ultimately getting paid. What that does, that sends more people online into all of the company's other competitors.
Now, of some of those retailers that you mentioned, I'm trying to go back in my mind because some of them do end up eventually closing the doors. There's no more Circuit City anymore, for example. What are the retailers, and I can't think off the top of my head, that have exited bankruptcy? Because there are a number of them. Right, JCPenney. So there are a number that enter bankruptcy. They do achieve what they're trying to achieve, and then they come out of it, and they might not be, thriving and huge and dominant, but they are surviving. So we'll see which path this ends up going.
And some of them only end up selling off the IP so that they can get some type of remediation financially. But I mean, we've seen that with Sports Authority. Sports Authority sold off their IP. You had, of course, Sears and like the Sears local play that you were talking about just 2 weeks ago.
They sold Craftsman, right? I believe.
Craftsman. Zombie retailers.
And Toys R Us, which now with True Kids and all of the other different iterations that's taking on, essentially being a seasonal IP play. And so it could be an IP play that we see come forward further in the future should the bankruptcy proceedings not be successful for them if they enter into that as well.
All right, let's focus in on a retailer that does have a little bit more cash, but perhaps wants to raise even more cash. Amazon announced it's firing upwards of 18,000 workers, its biggest set of job cuts in the company's history. The news was initially leaked internally, which prompted CEO Andy Jassy to make the announcement public. Amazon will inform employees on the specifics of the job cuts starting on January 18th. And of course, I think this is Amazon trying to use some air cover provided by Salesforce yesterday. Salesforce, of course, saying letting go 10% of its workforce, but another tech company that I think Andy acknowledged in his letter that to employees last night, another tech company just grew too much. The employee growth at this company over the past, you see it there on that chart there, you see how many employees Amazon added, a lot of them during the pandemic. Too many people to support this post-pandemic world.
I mean, at the same time, 18,000, well, it sounds like an enormous number. Keep in mind just how big Amazon is, right? We're talking about 1.5 million people that are employed by Amazon. So it's about a percent or so of the workforce, right? It's a higher percentage of the corporate ranks, which is reportedly where many of these cuts are coming from. One other note that I thought was interesting, because Andy Jassy came out and in a public blog posting and talked about these cuts. However, he did so because the Wall Street Journal reported on this, and as he alludes to in his letter, he says somebody leaked this news, and now rather than having continued speculation whispers, he's coming out and saying this is indeed what we're doing. So I give him credit for coming out and sort of addressing it head on.
Yeah, and in terms of where those roles are being impacted, several teams, he says, are being impacted. The majority of the role eliminations, they're actually going to be in their Amazon stores and then in their PXT, which is their people experience and technology organizations as well. And that 18,000 number, that figure, that also includes some of the reductions that they've already made in November. It seems like some of the communicated roles now are going to take place January 18th is the timeline.
So they still got to wait a little while to find out. I mean, that's tough.
One thing I do think is getting lost, and it's just the eye-popping amount of layoffs here, is the demand signal these initiatives are signaling to the broader market. I don't think it suggests we are in recession, but but it does suggest the economy has slowed perhaps a lot more than the market thinks in recent months or since year end. You have Salesforce, Amazon. I can't imagine both of those companies are going to be cutting thousands of workers if their sales re-accelerated into the new year and they saw even better business prospects for the first 6 months of this year. I mean, you're cutting bait with 18,000 people that theoretically could help grow your business.
And just on the jobs front as well, as we look ahead to the jobs report tomorrow, Challenger Gray and Christmas was out with its job cuts report this morning as well. And technology is leading here. In December, about 16,000 cuts, according to Challenger Gray and Christmas. The total for the year, 97,000. And that, they say, is up 649% from 2021 for technology. So this has been one of the worst years in tech in terms of job cuts.
One quick thing, Bed Bath & Beyond Comms is getting back to us saying they will provide a business update on their third quarter earnings next Tuesday. Again, declined to comment how much cash they ended in the most recent quarter, a very important metric for a very struggling retailer.
All right, significant update we got from Bed Bath & Beyond this morning, and of course a massive cut, at least on total number basis, from Amazon as well. We'll continue to track both of those moves here as we get closer to the start of trade on the day. We are also tracking the Capitol, Washington, D.C. The House remains in standoff after Republican leader Kevin McCarthy failed for the sixth time to gather enough votes to make him Speaker of the House. McCarthy is now fighting for political survival with no clear path forward, and the House is set to convene again today at noon to begin another round of votes. Yahoo Finance's Rick Newman is here with all the details. Rick, is anything going to change?
I think there's one really important change this morning. Elon Musk tweeted, Kevin McCarthy should be Speaker of the House. So that ought to settle it. I'm sure that they'll just nail this down once they start voting again at noon today. No, I'm kidding, obviously. It might seem like this is just repetitive and going nowhere, but apparently the progress that they're making on the House floor is that McCarthy has agreed to give even more concessions to these 20 Republican holdouts who won't vote for him, basically giving the far right wing of the Republican Party in the House even more power to determine what goes on in the House with regard to future legislation and the way McCarthy would rule over the House. But that doesn't mean he's going to win enough votes. And it also raises the possibility that he could alienate some moderates who are shaking their heads and saying, look, these 20 holdouts on the right, they're only 10% of House Republicans. Why are they putting themselves in a position to gain so much power, and why should we give them so much power? So that seems to be the essential conundrum here. And I guess the thing everybody's looking for today is to see whether McCarthy can increase the amount of votes he gets. And if he doesn't, the pressure is going to mount on him to simply bow out, because it's going to look as if, given we're talking about these concessions, even if he can't get the votes, even given those concessions, then he can't become Speaker. So that might be the thing that breaks within the next couple of days. But no one, as with the last few days, nobody knows where this is going.
And as you said yesterday, it's a fun story to cover. I don't know at what point it becomes less fun after it goes on for a week, 2 weeks, a month. I don't know, Rick. But I mean, you do wonder how long this can go on before it gets in order.
It can go on for a while.
Yeah.
I think the record is 133 votes before they elected a speaker, and that took almost 2 months. And it's fun to cover this, given that I'm not on the House floor trying to find a new storyline every minute. But, you know, what the cable news networks are showing, they're now getting into this game of focusing on who's huddling with whom and who is saying what to whom. And now there are people who claim to be lip readers on social media who are translating what Matt Gaetz said to Alexandria Ocasio-Cortez and trying to figure out who might be forming a new secret alliance based on, there are 3 people gathering over in that corner of the House floor. I mean, obviously, this is getting to absurd new limits. I like the way the Vatican does it when they have to pick a new pope. You know, they close it, they shut the place down, they keep everybody out. And when they have a pope, some white smoke rises from the Vatican. Maybe the House should try that.
There's already a lot of smoke that rises from Congress, though, so no, sorry. And Rick, just one thing, and you probably haven't seen this news yet, but I just wanted to flag it. The Detroit News is now reporting that Senator Debbie Stabenow is not going to seek re-election. Now, that's going out to 2024, and so that'll be yet another sort of rejiggering of things. But just, I don't know if you have a quick reaction to that headline that we're just seeing in the past few minutes.
Yeah, I mean, so with regard to 24, it's going to be harder for Democrats to keep the Senate in 2024. And Stabenow saying she's not going to run for re-election would mean yet another open seat Democrats would have to win in order to keep the Senate. So the problem for Democrats in 24 in the Senate is they're simply defending more open seats, just defending more seats that are up for grabs in 24 than Republicans are. And one of the biggest problems for Democrats is in Ohio, where Sherrod Brown is going to be defending a seat, and Ohio has tilted much more toward Republicans, so that has gone from being a swing state to being a Republican state. Stabenow in Michigan, probably Democrats could keep that seat, but there have been Republicans who've gotten elected in Michigan, so that is another problem for Democrats in 24.
But for now, they're sitting pretty, watching the chaos amongst the Republicans. Right. Thanks so much, Rick. Appreciate it.
Bye, guys.
Well, shares of Silvergate are plunging after the crypto servicing bank revealed its deposits dropped 68% in the fourth quarter. It's been forced to sell assets at steep losses as the collapse in the crypto industry takes hold. And of course, there's a whole FTX subplot as well. Yahoo Finance's David Hollerith is here with the details. Hey, Dave, and you were here, of course, in town watching the arraignment trial happen for SBF, and now this news is also developing. Talk to us about what's going on with Silvergate.
Yeah, the bulk of all crypto news right now still has echoes of FTX. That's sort of a given. And Silvergate's business grew a lot from trying to cater to crypto businesses. And that's really brought most of the pain for Q4. They put out their results this morning, and they showed that they had to sell approximately $5.2 billion in debt securities for cash at a steep loss, which is $718 million. And why that number is important is because the $718 million loss is more than the profit they've made since 2013. Now, in total, they saw $8.1 billion in asset withdrawals from clients. And, FTX and Alameda Research, the related firm, were both huge clients of theirs. So that's primarily what's going on here. Also, Silvergate had to reduce their headcount by about 40%, which is approximately 200 employees. Wow. And they also have this stablecoin project. They acquired assets from Facebook's Diem project that was now defunct. And that was a promising venture they had previously said they were trying to launch at the end of this year. And now they've said, that project's no longer going to be imminent. That's Alan Lane, the CEO of Silvergate, said on the call today. So it's not looking good for Silvergate in Q4.
Also within crypto, the SEC has obtained or at least objected at this point to Binance's deal, and this was to acquire Voyager. What is the latest there that we know?
Yeah, the SEC filed a motion objecting to the acquisition yesterday afternoon. And essentially, they're asking for more information regarding how Binance US would purchase the assets from Voyager. They're also asking about how Voyager will secure those customer assets, which also makes sense in the context of FTX, which had a huge theft right after they declared bankruptcy. But the key here that is going on is that it's a $1.02 billion acquisition. It's much less, but that's the debt they're taking on. And Binance US is technically not a subsidiary of Binance, the largest cryptocurrency exchange. However, through sort of corporate affiliates, the CEO of Binance owns a majority stake in Binance US. And so there's questions about the affiliation between those two firms. And obviously Binance International is not regulated in the US. So that's sort of what's trying to be determined.
Yahoo Finance's own David Hollerith on all things crypto. Thanks so much, David. Appreciate the breakdown this morning. And everyone, coming up, why our next guest is predicting a shallow recession in the first half of 2023. We're going to discuss next. Federal Reserve officials have reaffirmed their commitment to fighting inflation, but said it would take substantially more evidence of progress to be confident that it was on a sustained downward path. For more on the Fed's battle against inflation, we welcome in Anastasia Amoroso, who is the chief investment strategist over at iCapital. Anastasia, always a pleasure to speak with you and get some of your insights. So what do you take away from where the Fed is kind of positioning, what a trend may look like, and where and when it may feel comfortable pivoting or pausing?
Sure. Well, good to see you, Brad. And I think that quote that you just brought up from the Fed minutes is really, really telling. That was the most important takeaway for me from the Fed minutes, is that they need to see substantially more evidence. And it's really interesting because yesterday we had the stocks that rallied out of the gate because we seem to have started to get data that suggests that inflation is peaking. And for example, if you looked at the manufacturing ISM print, you saw the prices paid component come down significantly. In fact, almost as low as we saw in 2020. And then if you look across the board, there's goods deflation that's happening. There's fuel deflation. There's food deflation. So all of that is starting to occur. But again, back to that quote, that is not good enough for the Fed. And to your question and your point is, when do they actually start to pivot? Well, I think when the labor market cracks. And that was the problematic part with the news flow yesterday, is that we don't really see cracks in the labor market. Despite all the job cuts that we're talking about, the job openings are still hovering near all-time record highs. So that's going to take time. It's going to take more kind of economic growth pressure, I think, for the unemployment rate to eventually inch up. So, that's why for investors, yesterday to me kind of highlighted what we might expect over the next few months is this tug of war, inflation that seems to be peaking, but it's just not good enough for the Fed yet.
Anastasia, let me tick through some of these things investors have watched this week. I'm just writing them down as I ask you. So Salesforce just announced a 10% workforce reduction. Amazon cutting 18,000 workers. Bed Bath & Beyond this morning, bad holiday season, said they may go bankrupt. And Stitch Fix, this now crossing the wire. Its CEO is stepping down. As you step back, are these just all signs the economy is headed into a dark place at some point this year?
No, I don't think the economy is necessarily heading into a dark place, but I think a lot of these companies that you mentioned are in margin preservation mode. And to quote one stat in particular, if you look at the profit margin for the S&P tech sector, it was 24%. Well, it's now down to 21% because very quickly what happened over the last few quarters is the growth landscape started to deteriorate, but they've hired a lot. They've invested a lot in CapEx. So I think what the companies are doing right now is they're adjusting to this new growth environment and they're starting to lay off workers. And this is really difficult to say because obviously nobody wants to be laid off. But at the same time, from a company perspective, from a market perspective, that's sort of what you want to see is companies right-sizing their cost structures, because what happens on the other side of that, as demand eventually rebounds, those margins will expand pretty drastically. It happened in 2020, it happened in 2018, it happened in, after 2015, 2016. So I think the steps that these companies are taking now is to right-size the margin pressure, which ultimately will be a positive.
That said, Anastasia, if the Fed is going to be waiting longer or wanting to see more evidence that inflation is going to come down and take longer to wind down interest rate increases, that would seem to be especially hard for tech, because it's already been especially hard for tech, right? So does that mean that there's more downside there?
I mean, there could be, Julie, some more downside. I think we still need to see the flush out in the first half of the year. But I do also think we've seen so much reset across the board, and specifically in tech. So for example, if you look at some of the tech multiples for some of the software companies, they went from trading at 20 times enterprise value to revenues to 5.5 times. That's a massive reset, and they're sort of back to these normal levels. We saw the multiple correction in semiconductors and real estate, for example. So I think the bulk of the interest rate pressure has already been felt. And by the way, I do think the Fed funds rate continues to rise, probably north of 5%, but the long end of the curve, I think, has peaked, and we probably shouldn't retest the 4.5% rates there. So that's, again, a positive to me that suggests that the reset in valuations might actually be just about fully complete. Now, the other positive that I would say is that tech was perceived as this secular grower that's just going to escape, the cyclical pressures. And of course, we knew that's not going to be the case, but we're starting to feel it now. We're starting to see cloud revenues slow down and the whole digital transformation landscape slow down. So the fact that that's playing out now is, again, in that reset category that I think needed to happen and perhaps has already happened.
Anastasia Amoroso, Chief Investment Strategist over at iCapital. Good to see you. Happy New Year. We'll talk to you soon.
Good to see you. Speak soon.
Straight ahead, we'll break down some key earnings reports, including ones from Walgreens and Constellation Brands. We'll also have more on that CEO change over at Stitch Fix. That's next.
We're just a few moments till the opening bell here on Yahoo Finance Live, and we are seeing indications for a lower open. That's after we had that ADP jobs number coming in higher than estimated, leading perhaps to some speculation that tomorrow's jobs reports will
Wow, it's almost 9:30 already, Julie. Wow, so much going on today. I can't take it. I'm sweating. Just to let you know.
Can I,
sweating.
Actually,
I'm wet. That Bed Bath corner really threw me for a loop. Holy cow. I'm
Maybe
just,
you
like,
need to go to a Bed Bath & Beyond and get something to
those little plastic fans.
Tell yourself off. I don't know.
Dying, man. Dying here.
Service providing sectors within that ADP report added 213,000 jobs. That really kind of the brunt of that growth that we saw.
Yeah, and maybe sort of emphasizes what we just heard from Anastasia Amoroso, that the Fed is going to need to put its foot on the gas a little bit longer. There we got the opening bell here on this Thursday morning, as it does look like a lower open and people really anticipating the jobs report tomorrow. We actually have some earnings out this morning that we're going to talk about in just a moment as well. As we head towards the opening bell, we are seeing yields that are higher this morning. We are seeing stocks that are lower. We are watching large cap tech and beyond. Whoa. What are we looking at here, Brad?
I'm just toggling some charts over here, trying to populate it and make it look good for our viewers, but I put it on the year-to-date chart, and we are very early on in the year, so that's what you get, a solid triangle here on the year-to-date chart. But intraday out of the gate here, just to populate that, we'll give you a two-day view. Over the past 2 days, net lower for the Dow Jones Industrial Average by about 0.1%, but 0.5% lower here out of the gate this morning, down 187 points early in trade. We're also taking a look at the Nasdaq Composite. You've got the tech-heavy average down by about 0.7%. The S&P 500, that's lower by a little more than 0.5% right now. And then just after the opening cross, taking a look at some of the sector activity here, a lot of red on the screen as of right now. Energy, the lone gainer, flat just barely to the upside right now. You've got some downward pressure, though, in materials. That's lower and leading the pack lower, at least right now, by about 1.5%. Also taking a look at real estate, that's down 1.3%. And then additionally, technology, consumer discretionary, they're also lower here on the day, as well as healthcare. So we'll keep a close eye on all those names. Let's also just take a brief check-in on some of the Nasdaq composites or some of the components in the Nasdaq composite, rather, where you've got mega cap tech also slipping out of the gate this morning. Of course, Amazon, we've been continuing to discuss them given the employee changes or the layoffs that they had announced. 18,000 employees going to be impacted by that, and that net combined with what they had already announced in November as well. So taking a look at Amazon right now, and we'll just put this on a 52-week chart. I got to remember to now put things on a 52-week chart just for a little bit until we get some more of the year-to-date data.
I kind of like those triangles, though. They're kind of fun.
Oh, man. Yeah, you get very vector-based charts at this point in time.
I really dig it. All right. Well, I also dig more earnings analysis. Shares of Walgreens in focus after exceeding expectations of both the top and bottom lines for the first quarter. However, the company reported a net loss in the first quarter of $3.7 billion, driven by a $5.2 billion after-tax charge for opioid-related claims and litigations. Again, you see on an adjusted basis, you have Walgreens beating by 2 cents. So why is the stock down 5%? I do think they were a little light in a couple areas. One, on that U.S. retail pharmacy same-store sales, only up 3.2%. Also, the company, despite that 2-cent earnings beat, didn't come out here and really bolster their full-year outlook. I think embedding appropriate levels of caution given everything we're seeing in the economy.
Yeah, you also had some investments, so they're continuing to really kind of go at some of the debt that they do have, but also in some of the strategic investments that they have made. VillageMD's acquisition of Summit Health, that closed early in the year, and that's really going to be pointing towards their healthcare segment sales, and they're hoping to achieve a path to profitability there. But they also did see first quarter sales decrease by about 1.5% year over year, 1.1% up on a constant currency basis. But I think at the end of the day, for investors really looking to see where healthcare continues to have some of its legs going forward in 2023 for that retail and pharmacy play that Walgreens Boots Alliance as well as the CVS has, that's going to be under some scrutiny and some tough year-over-year comps, given what we had seen last year and some of the return to those capacities.
Yeah, I'm seeing a little bit of disappointment being expressed in the operating margin as well. Just one more thing to keep an eye on, in addition to what you were saying, the company maintaining its forecast rather than raising. So that's something else that folks are talking about. Let's also talk about shares of Constellation Brands. We're watching that stock this morning after the beverage company topped revenue estimates but missed on the bottom line for the third quarter. Wine and spirit sales down 4% year over year. The stock is down by 5% right now. I don't know. I don't think this feeds into the hard seltzer thesis that you were talking about yesterday. And it looks like beer net sales did top estimates here. So but some areas of a little bit of disappointment.
Yeah, I will refrain from talking about like the product per se. I think inflation surprised a lot of investors here with Constellation Brands. And I talked to Bill Nunes about this, I believe 4 or 5 months ago down at the New York Stock Exchange for I asked him if inflation peaked, and he told me no. And we didn't really get a sense of a peak here in that business. Operating income down in both the beer and also the wine and spirit segment for this company, despite them pushing through modest levels of price increases, calling out higher levels of inflation for transportation and packaging, much in the same way that impacted this business and a lot of other competitors to this company last year.
You know, one other thing that in this earnings season especially, and then even going forward throughout 2023, it's going to be interesting to track what the operating cash flow for some of these companies looks like too, because they're going to be more pressured to tap into some of that cash to really navigate through a pre-recessionary or even mild recessionary environment as we get towards that later on in the year, as anticipated by many of the economists that we've spoken with. And that's what we also saw within these Constellation results, a decrease on their operating cash flow about 7%, free cash flow decrease of 13%. So really tapping into some of that cash and seeing how they deploy that across the business too.
And we'll get to talk to Bill Newland some more on Monday. He's coming on with us at 10:30 so we can talk much more about what he saw and whether he now thinks perhaps inflation has peaked.
I do like that new Corona Premier. Good brand. Low calorie, low carb, works for me.
Okay.
Yep.
Let's also talk about shares of ConAgra Brands, ticker symbol CAG. We're seeing those move higher by about 5% here early in trade. This is following an earnings beat on both the top and bottom lines as the food company saw net sales increase 8.6% year over year. It also raised its fiscal 2023 guidance as they now expect organic net sales growth to be between 7 and 8% for the year. That's part of what was within this quarter is that net sales growth, but then additionally, strong snacks business too.
Get this one, brace yourself. The frozen food business for ConAgra is really starting to heat up. In terms of profits. Because while we just talked about Constellation Brands still seeing high levels of inflation, this is the second straight quarter for ConAgra Brands that inflation started to come well off its highs, and it's really impacting their operating profits for their grocery and snack segment and the refrigerated and frozen food segment. Grocery and snacks operating profits up 36.6%. Over in the refrigerated and frozen segment, profits up 48.6%. Those are growth rates that I'm just not seeing in a lot of ConAgra competitors.
You know, and we were just talking about operating margin over a Constellation, or were we talking about that with Walgreens? Now it's all.
We weren't talking about Bed Bath & Beyond. They have no margins, Julie. They have no margins.
In any case, adjusted operating margin at ConAgra, 17%. The estimate from analysts was just 14.7%. So that's a pretty impressive beat. And the company does talk in its statement about decisive actions to offset inflation. In other words, cutting costs and raising prices. And it seems like that was successful for them.
Yeah, absolutely.
They've done a good job improving a lot of their frozen food. I eat their payrolls. Yeah. They're really good. They have quinoa in them. They taste good. They don't have that nasty frozen taste anymore. I'm all about ConAgra. I feel them.
I have to become a fan of quinoa then.
Quinoa. Not a fan of quinoa.
Great.
Quinoa is great. Yeah. All right, 2 against 1. All right, another company disaster we'll loop in with Bed Bath & Beyond today. Shares of Stitch Fix. We're following that one after the announcement that Elizabeth Spaulding will step down as chief executive and as a member of the board of directors effective as of today. Founder and former CEO Katrina Lake has been renamed to the role and will serve in an interim capacity for 6 months or until her successor is appointed. Another boomerang CEO, as they would say, Bob Iger coming back, Katrina Lake, founder, coming back to lead her company as well. And we wish her well. I can't see what type of changes she can enact at this company. She was leading them really up to the point that Elizabeth Spaulding got appointed, I believe, 1.5 years ago, 2 years ago. Stock down 84% in the past year. It's a tough situation. Situation.
And a couple of things to say here. First of all, it's interesting that she's putting a time limit on this. 6 months, that's the time that the company has to find a new CEO. That's interesting. Secondly, it's interesting that Elizabeth Spaulding is leaving effective immediately. Mm-hmm. That's interesting as well here. And one more thing, you were talking about the stock performance. The stock went public. I remember this back in 2017 at $15 a share. It's trading just over $3. The stock actually rose in the pre-market after this statement came out, and then that gain went away.
Their execution has been abysmal. Pretty much every single quarter that they have gone public, it's awful. Even when they beat, there were concerns on the street about their level of execution. Now they're trying to pull back on marketing, which is the lifeblood of this business, to make an earnings number, and they still can't make an earnings number.
Yeah, I mean, in shifting the business from the procure and pack for people to the now optionality of picking and then packaging within that freestyle segment that they had launched as well. I think within the delivered fashion, sure, you were looking for any type of boost post-pandemic, or at least after we had gotten back into some of the social constructs and been a little bit more comfortable with refreshing our fashion and wardrobe. But it also came at a time where there were so many other options in that delivered fashion, from fast fashion players that have brick and mortar experiences in tandem to the new rise of some of the online and social first, like a Shein and even like some of the other influencer driven plays out there too. And so for Stitch Fix, I don't know, I felt like I could get some of the fashion that they were offering at Target. Why not just walk across the street for that?
Rent the Runway doing pretty good though. I know. Julie Trade.
I wish they had men's stuff.
Me too.
Guys, coming up, Yahoo Finance's Inez Ferre is going to break down the latest market action ahead of tomorrow's jobs data. We've got that coming up next. Welcome back to Yahoo Finance Live. Markets are in the red right now. The Dow down by a little more than 1%. S&P 500, same there on a percentage basis. Nasdaq down by about 1.4%. Let's get on over to Yahoo Finance's Inez Ferre for more on today's early activity. Inez, good to see you.
Good to see you, Brad. And let's take a look at where we're at with energy, because we did see over the past two sessions oil really getting hit, down about 9% in the last two sessions. Right now, we're looking at WTI that's down just 0.1%. Actually, it was in the green, has turned negative again. We're also looking at Brent crude that's near the flat line right now, but it had been in the green again, turning negative in the last several minutes of trading. Taking a look at where we're at with the sectors, we are watching materials, which are under pressure, real estate also under pressure, and technology. Energy is the lone survivor today, slightly in green territory. But looking also at the Dow, we're watching the Dow that's under pressure, and the Nasdaq, Tesla down more than 4%. You've got the semis that are also underwater. I do want to point out with crypto-related stocks, we have been watching Coinbase. This was downgraded account to market perform. That's down 11%. And I will note another stock that we've been watching in the streaming chart, and that is Roku. Roku was up in pre-market. It was up after announcing its number of global active accounts now exceeding 70 million. It is now down 0.3%, guys.
Inez, thank you so much. And obviously that's reflecting everything that was up and now is melting away. Appreciate it. We're looking ahead to the jobs report tomorrow. We're also going to get the final read on December PMIs from S&P in just a few moments here. Remember, yesterday we got an ISM manufacturing number that came in a little bit weaker, even as we had jolts that were a little bit more robust. So definitely a lot of mixed economic data that we are watching right now. And the market, especially in the wake of the Fed minutes yesterday, taking most of it as sort of negative here, that the Fed is maybe going to be more aggressive than the market had been pricing in. That seems to be the broader takeaway here as we see yields move higher as well here today. So if we look at that PMI number, it's coming in pretty much in line with estimates. Services PMI at 44.7, the final read on the composite PMI, 45 for the month of December. Remember, anything below 50 does signal contraction, so still seeing that in contractionary territory. But again, just adding this to all of the other evidence that we are watching for this year. And coming up, we're going to look at a few top ETF plays as 2023 gets rolling right along. We'll be right back. As decisions unfold or not in Washington, our next guest says fiscal spending could provide ballast heading into 2023, specifically with EVs and infrastructure. That's the stuff that's already decided upon. We don't have to worry about the arguments in D.C. now. Jay Jacobs, BlackRock U.S. head of thematic and active equity ETFs, joins us now. I guess it's more helpful right now to look at what's done rather than what's going to get done, Jay, given what we're seeing unfold in Congress right now. But given what has been done, given that the so-called Inflation Reduction Act is still, a lot of that is yet to be sort of put into actual effect. What should investors be watching for this year?
Well, I think we're at a really exciting stage for infrastructure, because if you think about this process, everything from making new legislation to award, the $1.2 trillion in the Infrastructure Investments and Jobs Act, or the $370 billion in the Inflation Reduction Act, that all was completed in 2021, 2022. The next stage is the government bureaucracy. Various agencies like the Department of Transportation or the FCC have to determine how to allocate those dollars. The dollars get allocated. You see massive projects like rebuilding a bridge that can take years. Finally, the fourth stage, we get to enjoy a fancy new bridge, or we get to enjoy faster internet access. We are in stage 2 right now. It has passed the major legislation. Now you're seeing those allocations. Just yesterday, about $2 billion was announced for various bridges across the country, from the Golden Gate Bridge to the Brent Spence Bridge in Ohio and Kentucky, to various bridges in Connecticut and Chicago. So this is an exciting inflection point. Dollars have been earmarked. Now they're being allocated, which is great for construction engineering companies.
Jay, kind of in the spirit of what we saw with GE Healthcare finally having its spinoff and going public and listing yesterday, wanted to get your sense on healthcare as a theme this year. It seems like consolidation is going to be part of the industry. Heavy R&D, post-COVID vaccine pushes, candidates that we had seen of the past 2 years, and then the rollouts of those vaccines, and then additionally some of the spinoffs that we know are finally starting to activate.
Yeah, there's really two compelling reasons to own healthcare right now. One is that it tends to be more stable during a recessionary environment. This is not something that people decide to spend money on. They have to spend money on it. And a lot of that money is also funded by government spending. So that gives it some really defensive properties. But maybe on the more growthy side of the spectrum, there's been a lot of advancements in healthcare just over the last 3 years because of the COVID-19 pandemic that we could finally start to see monetized. As you were mentioning, COVID-19 vaccines can leverage some of that technology from mRNA to potentially create vaccines for HIV or for the common flu. We're seeing incredible mRNA potential advancements in areas like cancer treatments. So you start to see this technology being repurposed and put into various trials. We think 2023 could be a huge year for medical breakthroughs, providing a nice growth opportunity within the healthcare space.
Jade, are there themes you think that just won't work this year?
I would really be skeptical of kind of long duration, non-profitable tech themes this year. Think about this as a pendulum. There are times when people want to make big bets, that they have a long time horizon, that they have very cheap access to capital. That's great. That means you can invest for major transformational technologies. But right now, we don't have that. We have companies cutting back, layoffs across the tech space. We have more expensive capital right now. So companies don't want to bet on moonshot technologies. So I would avoid those non-profitable tech companies and focus more on what is really recession-proof, like infrastructure, like medical breakthroughs, or even areas like cybersecurity, which is technology, but it's become a staple for many companies.
All right, let's leave it there for now. Jay Jacobs, BlackRock U.S. head of thematic and active equity ETFs. Always good to see you. We'll talk to you soon. All right, just because music icon Cardi B has a reported net worth of $80 million, that doesn't mean she isn't watching every penny she spends. The notorious watcher of financial topics tweeted out her dismay with inflationary grocery prices. You can see her tweet on that screen. Here's a not so fun fact for you, Cardi B. Egg prices surged almost 50% last year. Get at us on Twitter with your hot take on that one. Coming up, thinking about investing in tech, I'm going to talk about some steps or signs you should be looking at before you pull the trigger.
The tech sector, of course, took a beating in 2022, tumbling more than 30%. 2023 widely expected to be another volatile year. But will there be light at the end of the tunnel? What should investors look to buy back into tech? And that is Brian Southey's take today.
Yes, I just want to run through a very simple playbook. If you're watching some of these really eye-popping layoff announcements this week from Salesforce, Amazon, there are probably more coming from big cap tech names in the weeks and months to come. But let's just get a playbook on things you should be looking for before putting money to work in the battered tech space. A couple very simple things here. More job cuts. Before you invest in any tech stocks right now, you would want to see, I think, the company having taken pretty sizable expense cuts just to help improve their profit profile and profit margins, cash flow, and what looks to be a continued slowdown in sales growth, as indicated by the results or the letters put out this week by Salesforce and Amazon. Number two, peak interest rates. We talked about this with Paul Meeks, longtime tech watcher, yesterday. It's unlikely, even if you do get those you get more job cuts from tech names, without a signal or an indication the Fed is going to just stop raising rates, which may or may not happen until later this year, just given where inflation is, it's unlikely these tech stocks will work as much as many people would think. You have to get a sign that interest rates are going to just level out here or in fact come down in 2024 before tech stocks go off to the races. And lastly, too, another factor that Meeks brought up, he would like to see trough earnings per share estimates. And if you look at the estimates right now for the Nasdaq Composite companies, they have not peaked. They have only declined, I would argue, very slightly. You can see that chart right there right now. So earnings estimates for tech companies, there's still a lot of hope and belief that tech companies could still deliver this year. And those are, way I'm thinking about it, those are definitely not trough EPS estimates on the street like a Meeks and like other tech watchers would like to see. Overall, before you wade into the water of tech, I do think you need to see all of these factors converge. That likely peak interest rates, more job cuts, and trough EPS estimates before really pulling the trigger on some of these names. Best believe a Salesforce and Amazon, I've watched the market reaction to these cost cuts this week, and they're already starting to think about what else can they be doing to please Wall Street.
Right, and not all of them are the same, right? Because you think about tech broadly, but at the same time, coming down to how they're making that revenue and where that margin comes in from. For some of them, it's ad tech. You don't know when those advertising dollars are going to flood back into the market. And for some of them, it's on the more consumer discretionary side. So in consumer discretionary, there's still this divergence between what's a necessity in tech that somebody has to hold in the palm of their hands every single day versus something that's just a luxury and a service that they may tack onto that experience too.
Yeah, of course, you're right, Brad. All these things are company specific in a lot of cases, like Robinhood. They've laid off or fired 23% of their workforce last year. How much deeper can they go before it actually starts to impact their services? For a company like that, I would say it's more important to see signs of revenue reacceleration than signs that they may cut more employees.
Absolutely. We're going to continue to track tech very closely, as we know you will as well. Coming up, we're going to go to Las Vegas, where Dan Halley is on the Strip, standing by for the latest updates from CES.
Oh, we wanted cars. We're going to get cars.
Oh.
Boom, boom.
Welcome back to Yahoo Finance. I'm Brian Sazi here with Julie Hyman and Brad Smith. Markets, well, they're tiptoeing into Friday's big jobs report, especially with Wednesday's Fed minutes being on the hawkish side. Right now, we're seeing really losses accelerate to the downside, though. All three major indices are currently in the red. Now, here's what's on tap this hour. Some new electrified products from Tesla. We have the details later on in the show. And handing out those pink slips, Jefferies tech analyst Brent Thill stops by in the wake of big layoff announcements this week from Salesforce and Amazon. Are these stocks a good buy? We'll find out. And burning up dat fat in the stock chart. We talk with Exponential Fitness CEO Anthony Geisler about the appetite to get fit in January and why his stock has rallied in the past year. Brad, let me hand it over to you and your fit self.
Well, thank you so much. Taking a look at the S&P 500. As of right now, we're seeing the S&P down by about 0.9% here. As you were mentioning, Saz, a moment ago, all the major averages are in the red. S&P 500 lower, and almost all of the 11 S&P 500 sectors in the red too. Energy is the one gainer here on the day. That's up by about 0.5%. So 10 out of 11 S&P 500 sectors in negative territory. The Nasdaq Composite, a lot of red on the screen there. However, you do have one bright spot. Well, a few bright spots, but one of those among mega cap tech names right now is Apple. That's holding on to gains of about 0.9% here intraday. Some other leaders that we're seeing within the Nasdaq 100 right now, Netflix is actually up by about 0.8% as well. Some strong viewership, it seems, for a movie that has just made its way into the top 10 most watched movies on Netflix. Glass Onion, perhaps you've got some viewed minutes or hours out there as well, folks. And then additionally here, I did want to take a look at some of the chips and the chip activity that we've seen. Semis, there we go, okay. And this is where we're seeing some down activity for some of the larger names like an NVIDIA. You're seeing Applied Materials lower as well, Qualcomm. A lot of red on the screen. Micron, the one gainer here by about 0.5%. But this was after a warning as well that we saw from Samsung and signaling some tough times ahead as well within its DRAM and NAND chips and ambitions there. So we'll continue to see where that also sends some shockwaves perhaps throughout the rest of the semiconductor space. Switching gears here, fears at the Federal Reserve rising that markets just might not be getting the message. The Fed is serious about fighting inflation, and this is after recently released Fed minutes showed frustration that its rate rises are being taken as a sign that rapid slowing will follow. Market observers, meanwhile, worrying that a sharp slowing could tip the U.S. economy into a recession. Joining us now with more, we've got Tom Essay, Sevens Report Research President. Tom, good to have you here with us this morning. The Fed has seemed acknowledging, at least in the past, that their policy pathway may cause a recession, but it's the extent of the recession that markets are trying to price in as far in advance as possible right now. But do you believe that there will be any swift pivot given even the jobs data that we saw in private payrolls this morning?
Good morning, Brad. Thank you for having me on. The short answer is no. The two key variables that investors have to watch as we start the year are employment and inflation, and they need both of them to go down in order for the Fed to pivot, and it's just not happening. And we saw, the reason the market is down this morning is very, very clear. The jobs data is too good, and I realize that may sound weird to investors at home, but the bottom line is the Fed won't be confident that inflation is going to truly subside until the labor market gets less tight, and it's just not happening right now.
Well, Tom, what's the market reaction then if tomorrow we get a better than expected jobs report by a wide margin?
More of the same. We'll see continued selling because the market. So here's the interesting thing. In December, the Fed came out and said we're going to raise the Fed funds rate above 5% before we're done. The market does not believe them. If you look at Fed funds futures, they are pricing in a Fed funds rate at the end of this year well below 5%. So there's this game of chicken going on between the bond market and the Fed, and whoever is going to be right is what we have to watch as the year progresses.
Well, and we heard from the Fed again yesterday that they didn't appreciate that game of chicken, that they want markets, they want stock markets to be lower, they want yields to be higher. How do you think this is going to end up, Tom? Who's going to win in this game of chicken? I mean, usually, I don't know about usually, the Fed makes mistakes, certainly.
Yeah, absolutely. I think that, listen, we always have to heed the advice, don't fight the Fed, right? And we have seen over the past year that the Fed is serious about raising interest rates. But here's the thing. The Fed is just following the data. The Fed was late to react to the spike in inflation and now is chasing inflation higher by raising rates. And what the market believes is going to happen is that inflation is going to roll over and growth is going to roll over, and the Fed is going to have to chase the economy down by cutting rates as the economy slows. Now, that's not happening yet, but the market seems quite confident that it will happen, and this is part of the risk to investors as we begin the new year.
By your estimation, when would the economy slow to the extent that the Fed is looking for?
It depends, right? We're seeing some pretty quick deceleration in the growth metrics, especially in manufacturing. So one thing we have to keep in mind is you've got to separate the economy into two pieces, right? One is manufacturing, the other is service sector. Manufacturing is slowing. I mean, manufacturing may already be in a recession. The issue is service sector, right? The service part of the economy. That is staying very resilient. That is driven by employment. So if the Fed accomplishes its goal, we should see that really begin to slow, I would say, end of first quarter into the second quarter.
Tom, good to see you. Tom Essay, Sevens Report Research President. Appreciate it.
Thank you.
It's not just the lights of Las Vegas that are beckoning. It's the LEDs, drones, TVs, headlights, other gadgets coming out of the yearly CES convention. We got Dan Howley on the scene, swiping, driving, tapping, and trying his way through the halls in day 2 of our coverage. And he is here with us now. So what's the latest there, Dan?
That's right, Julie. This is the second day that we're here, officially day 1 of the big show here in Las Vegas. And we've heard so far a slew of big announcements. I just want to run you through some of them that we've already heard. We talked about Intel. We talked about NVIDIA yesterday. AMD now is coming out swinging. They announced their own new CPUs and GPUs. They have the Ryzen HX and HS mobile processors. Those are for hardcore gamers. The HS version, meanwhile, that has some AI components built in. The reason for that is to provide better processing overall as we move forward and AI becomes a bigger part of the general computing process that people experience. There's also the RX 7000 graphics chip. This is also going to be on mobile devices, laptops, notebooks, things of that nature. And it's really made to be taking a shot at NVIDIA and their RX chips that they had announced yesterday. A lot of R's, a lot of X's going on here. Suffice to say, both companies have really cool technology out there right now, or that's going to be coming later this year, 2023. We also saw BMW roll out an absolutely wild new concept car. This is the iVision D. I just want to get this right real quick. D stands for Digital Emotional Experience. Okay, essentially this car has 240 e-ink panels on it. Those really allow the car to, I'm not even kidding this, change colors. It can go 32 different types of colors, infinite possibilities then when you want to kind of change up how your car looks. So you can add stripes, you can add, I don't know, circle designs. I'm not very original when it comes to designing my cars, but you can do it if you want. There's also this, I don't mean to laugh, but you can make an avatar and have it look at you when you walk up to the window of your car. So you can have your digital avatar wave at you as you approach. You can also make the kidney grill smile at you. So it's a wild exterior experience. On the inside, there's a kind of full windshield head-up display that can go from providing just basic driving information all the way to virtual reality. It can dim the windows. Again, this is a concept. No one's going to be driving down the Grand Central Parkway in Queens with an avatar in the side mirror and, in virtual reality while steering their car. In addition to that, we had Sony and their press conference last night. They announced that there's finally no longer a delay with their PlayStation 5 console. It only took them about 2 years for that to happen. And now they're also announcing something called Project Leonardo. This is actually a very cool device. It's for accessibility needs. So anybody that can't necessarily use a regular PlayStation controller will be able to buy one of these. And basically it's customizable. You can take these different pieces and attach them and rearrange them however you need. And it's really cool to see more companies doing this. Microsoft has its adaptive controller, similar idea there for people who have needs that they can't have fulfilled with a standard controller. So more companies getting into this space, absolutely a great thing. I just want to go find that BMW and have it wink at me.
Dan, so much cool stuff it seems like you're seeing through it all. Is the P tracking toilet the most exciting thing you've seen at the event?
Look, I gotta say, the pee tracking toilet is awesome. I'm not gonna lie. It's Weavings. It's not the toilet itself. It's a puck. So we've just been calling it the pee puck, but it does tell you about your basic health and cycle tracking. So it's a very interesting device. We literally saw a crowd of people standing around it when we went to it, not using it, of course. That would be weird.
Well, in this day and age, maybe it won't be so weird. Dan Halley, enjoy the event. We'll check back with you later. All right, staying on tech, the team at Jefferies has combed through GameStop's latest 10Q filing and aren't liking what they saw. Says Jefferies, the long-term growth prospects and lack of communication from management remain a key source of speculation. We take a prove-it approach as we are not currently modeling profitability into the fourth quarter of 2023. Coming up, San Francisco is seeing some brutal weather. Our weather expert, Julie Hyman, has more on that and other top headlines next.
Let's get caught up on some of the other headlines that we are watching this morning. First, to weather in California, where officials are warning of flooding and mudslides as storms are expected to drop 6 to 10 inches of rain in the state. The more than 8 million residents of the San Francisco Bay Area are being warned not to travel, and there are regional evacuations along parts of the coast. Meteorologists have forecast a so-called bomb cyclone, the result of a sudden drop in atmospheric pressure that triggers especially strong storms. California has been experiencing severe weather all week, causing flight cancellations and knocking out power to more than 100,000 people. Data, including email addresses and account names for roughly 235 million Twitter accounts, has reportedly been leaked and posted to an online hacker forum. The leak appears to be related to a hacker who claimed to have obtained private data on over 400 million Twitter accounts and in December requested a $200,000 ransom to delete the files. That 235 million figure the result of removing duplicates. The Washington Post has reported that the leak puts anonymous whistleblowers and political dissidents around the world at risk. Remember, most Twitter users live outside of the U.S. And Fanatics is reducing its majority stake in NFT company Candy Digital, according to CNBC, which cited internal emails. This comes as sports NFTs see declines in valuations amid the broader crypto winter. Fanatics will sell its interest in Candy Digital to an investor group led by Mike Novogratz's Galaxy Digital. In an email, Fanatics owner Michael Rubin wrote, "It has become clear that NFTs are unlikely to be sustainable or profitable as a standalone business, and that divesting at this time allows investors to recoup most of their investment via cash or additional shares in Fanatics." Saz?
A new strain of the COVID Omicron variant now accounting for 40% of cases in the U.S., according to the Centers for Disease Control. And prevention scientists have named this subvariant Kraken. Yahoo Finance's senior healthcare reporter Anjali Kamlani has details. Anjali.
That's right, Brian. And a note, it's not officially called Kraken. It is just the nickname given for now because we ran out or have not been given a Greek letter name for it just yet. But let's get to what it is. XBB 1.5, that is the new variant first found in the U.S. And it is also nicknamed the U.S. variant for that reason. Some details about it that we know right now is that it is highly transmissible, the most transmissible to date. We're not sure about the severity of it just yet for a multitude of reasons. Number one, because of the number of individuals that have either had COVID or are immunized by vaccines. But we do know that it is causing some hospitalizations. We're seeing that increase, especially in the most vulnerable populations, the elderly and the immunocompromised. So, quick tip, make sure you wear masks and definitely get some level of vaccination. And that's really what experts are focusing on right now. There's a lot that we still need to learn about this variant, but it is the one that, as you said, Brian, it is now accounting for 40% of the population, so something to really watch out for.
And while we have you, Johnson & Johnson's consumer health division is readying itself for an IPO, a public debut. What do we know about it?
Well, we knew it was coming. Not really newsy there, but what we do know is that, of course, this is the unit that holds all your favorite brands, Listerine, Neutrogena, Tylenol, the like, and it is part of really what is a new trend among big pharma of releasing and spinning off their consumer units. We've seen a number of other companies do this, and it seems like J&J is on board there, and it kind of fits into the trend of what we've seen with these companies really focusing on, the bigger payoff products like the drug products and med tech in the case of Johnson & Johnson. So we'll get more details on the IPO itself in a later date.
All right. Yahoo Finance's own Anjali Kamlani, thanks so much for breaking this down for us. And coming up on the other side of this short break, everyone, blazing into 2023, we're going to break down the year for cannabis. That's coming up next.
Let's get to another check on markets here as we see stocks fall today, and not quite at the lows of the session, up off of the lows of the session, but still not a great look here. If you take a look at the Wi-Fi Interactive, I've taken a look at the intraday of the Dow Jones Industrial, which bounced off the lows around 10 a.m., but we are still seeing the major averages down in the neighborhood of 1%. You guys, you know what I was just reflecting on briefly?
Tell us.
Just reflecting on the VIX here, which is at 22.5 today. And you're like, a 22.5 VIX, whatever. Like, that used to be really high VIX, really high volatility. And volatility has been so normalized. This is a 10-year chart. Volatility has been so normalized since the pandemic that it's reset higher. This is just the environment now. I was just having a little reflective moment there.
That's just an awesome moment. My moment is who are the market share winners when Bed Bath & Beyond goes out of business before this holiday season. I'm thinking of Target. I'm thinking Home Goods, TJ Maxx. I'm thinking Marshalls. I'm thinking Macy's. So,
ooh, the 10-year chart of Bed Bath & Beyond on here.
Brutal. That stock now, losses accelerating to the downside, down about 22% so far today. Of course, as we broke down earlier in the show, company really suggesting that it may go out of business, saying it has serious concerns about continuing as a going concern, and also mentioned that it could file for bankruptcy. Of course, it didn't do so today, but it could.
Well, one company you didn't mention that has already been taking some of that market share from them, it could be Amazon. And Amazon seeing any net add on its e-commerce business from the inventory that Bed Bath & Beyond would have gone after. They're having trouble securing that inventory because of their credit rating as well right now. And so if you don't have the ability to take on more of that inventory and then ultimately churn through it because of the consumer expectation within that own experience. And then you get into who else might win, and it's perhaps some of the either home registries or the wedding registries. We talked about that before, and historically how they've been able to benefit from that business, baby registries even. And now if you see more of that business overflow into a Williams-Sonoma or some of the other categorical players, then I think that's where it gets kind of offshooted towards, or that volume starts to diverge towards as well.
Even Bed Bath's towels, they're not that good. They've gotten kind of scratchy.
Okay, we got to go, guys. We're going to talk about the state of cannabis next. Stay with us.
Needham forecasts the cannabis market will grow 11% in 2023. But is that enough growth to sustain the industry as high taxes, barriers to interstate commerce, and then rising costs continue to challenge the industry? Here to discuss, we've got Poseidon Asset Management co-founder and managing partner, Emily Paxia. Emily, great to have you here with us. Help us break this down just a little bit further here, especially given some of the barriers that the industry as a whole is continuing to run into here in the U.S.
Yep. Much for having me today. I think when you consider the cannabis of business or the business of cannabis, that barriers are just a part of doing business. We've been investing in cannabis since January 2014, and there has never been an easy time in cannabis and building these businesses because of the federal status still being a Schedule 1 narcotic. We have egregious tax rates that the 280E tax code applies to these businesses, giving it above a 70% effective tax rate. Not to mention the fact that we're still dealing with patchwork legislation across the country. So the regulatory framework is different in each state. So every operator has to calibrate and adjust as they go into new markets. Now, the exciting part about this is that new markets are opening. For example, at the end of December, you already saw the very first sales of adult use cannabis in New York. Last year, New Jersey opened, and that was a tremendous tailwind for the industry because we saw unlocking of a brand new market in a region where actually you don't have that much adult use cannabis. And so these things are exciting in spite of the headwinds that we've been facing the entire time of running in this industry.
Hey, Emily, it's Julie here. It's good to see you. I have to point out, weed stocks did not perform well last year. You have an ETF that tracks them. You have individual investments as well. It was a tough year from a stock perspective, anything risk related, really. And so I'm curious, given that it doesn't look like there's going to be any catalyst on the federal regulatory front, what catalysts are you looking for any kind of potential recovery here?
It's interesting. When I hear investors who are looking at the space, they are watching for catalysts. We're really focused on building businesses. So even though the stocks had a difficult year, it has been very interesting to watch how the businesses have navigated through that time. We are still seeing growth, as you pointed out, year over year in this industry. I look at Silicon Valley. They've now started to talk about things such as free cash flow, EBITDA. These have been things that we've been focused on in this industry for as long as I can remember, because we have never known where the next flow of capital would come from. And yes, the catalysts are important because that's what opens up the access for other investors to come in. It's what drives the desire to come into this sector. But in the interim, while we're watching for catalysts to come, we're really just focused on building businesses. And I think that when investors have an opportunity to really pay attention to this sector, they'll see very attractive businesses and really a new consumer product segment emerging in the United States. You can see that there's been a decline in consumption of alcohol around especially the millennials and Gen Z. Cannabis is there to pick up the torch and run with it. And I think that's a really exciting potential kind of consumer product shift that we're seeing. So in terms of catalysts, though, there are things on the horizon. The president, spoke up and he said that he was going to look at rescheduling or descheduling cannabis. He also said in the same breath that it should not be at the same level as fentanyl. So if it goes below the schedule or in a better schedule than fentanyl, and I, by the way, wholeheartedly agree with him, we should see massive benefits to the industry. That would unlock the 280E issue that I was just talking about earlier with the taxes. Further, it would give us much more opportunity. They passed the research bill, so we can continue to research the health and wellness benefits around cannabis. So those are just some of the catalysts. Safe banking was the thing that did not get introduced this year. It should have been introduced. It was a failure on the part of the Democrat Party, and the Republicans holding it at bay as well. So it should have been passed. It has overwhelming support in the United States from a constituent level. But if that gets introduced again, there could be a good chance for it, but we're not holding our breath. We're focused on other paths to work through this and continue to grow this industry.
Emily, we were just showing some of the stock prices and some of the established players, and the declines have been stunning. We're essentially here talking about penny stocks of companies that were significantly higher about a year and a half ago. Do some of these big companies need to merge just to serve as a clearing event for other companies to emerge and maybe fetch some higher valuations?
So I see that you're showing the Canadian tickers right now, like Canopy, Aurora, Kronos. Those are not the companies that I'm talking about. I am talking about the health of the US companies. I'm talking about GTI, TerraSend, Curaleaf, TrueLeaf. I'm talking about Ascend Wellness Holdings. I'm talking about companies that I think are contributing in terms of building businesses and focus on the bottom line. These companies have the ability to raise money once the industry starts to get the attention of the institutional investor community. And I think that that's really where we're focusing. In terms of the Canadian operators, they've had a bit of a different experience because early on in the Canadian markets, they had a real flow of capital into those businesses. And I think they just weren't focused as much on the fundamentals of the business. They were focused on growth at all costs. And frankly, there was a lot of overbuilding. And you know, in the United States, we had the opportunity to learn from that. And if you look at the US operators, the CapEx spend is substantially behind them. So now they're really going to be leveraging the assets that they have across the different verticals and across the states that are unlocking.
Emily, it's great to see you. By the way, we have a front row seat to the New York rollout. The new shop is right around the corner from our office. Emily Paxia, Poseidon Asset Management co-founder and managing partner. Good to see you. Thank you.
Great to see you.
Coming up, new year, new fitness resolutions. We're going to speak with the CEO of Exponential Fitness next.
Shares of Amazon are on the move after the tech giant confirmed it will be cutting over 18,000 jobs, far more than originally expected. Our next guest is warning that Amazon has the most downside in 2023 due to cost headwinds and the potential for slowing consumption. Jefferies analyst Brent Thill joins us now. Brent, always good to see you. Pretty sizable cuts here by Amazon. Do you think that is their initial down payment and we should expect more cuts from them in the months ahead?
Expect more cuts for the rest of tech in the front half. The outlook is getting worse. Microsoft CEO yesterday delivered a message that it's going to be 2 years before the next big tech inflection. That is from one of the most honest and upfront individuals that I know in the industry for the last 20 years. It's a very sobering outlook, and I don't know how to put this, but we're headed to a recession. Jefferies' internal economists believe that this is going to start later and last longer. That is not good news. And so I think ultimately we're just seeing the beginning of what's to happen. Salesforce yesterday, again, big layoff. Elastic, Stitch Fix, I think today had a big layoff. You look at across the board what's happening in tech and e-com, it's very sobering, and it's not good, and it's not a great sign of future demand. So ultimately, I think we overhired as an industry into the pandemic. The pandemic created an artificial bubble, pulled demand forward, and then we come out of it and we have a hangover, and then we head right to a recession. So that is just a toxic buildup, and it's going to take a while for that to stabilize. That then puts us at, when's the next rebound? Is it 2024? In Nadella's terms, this might be 2025. And so in the short term, companies have no other choice but to tighten their belts, get back to growth at a profitable measure. Most of tech is growing with no regard to profitability, and that has to change because investors will drive those stocks to zero if they don't produce profitable growth.
And so,
not a great outlook. Sorry to be so sober.
Yeah, no, it's a really sobering picture that we're all trying to wrap our heads around. And so with that in mind, part of what we had seen in terms of the issues for Salesforce was this issue of headcount, seat count compression, I should say, rather, and how much that actually might be a larger industry issue that we should just be waiting for the shoe to drop at other companies to give their updates on that similar basis.
Yeah, I mean, it's a good point. So if you continue to lay people off and Salesforce and others are seat-based, you need less seats. And theoretically, you create shelfware, if you will. And that will sit around. And so as companies rehire, they may not have to actually bring back as many seats as they come back up. So again, this is a situation that we haven't seen for a long time. And ultimately, again, I think the pandemic, every tech company tried to do to help everyone become virtual and remote. And unfortunately now you've got that unwinding, you've got the economy unwinding. And so the good news for tech is that multiples have compressed, and we're now seeing multiples that are, in many cases back at trough levels. And then the question now is how much lower do numbers and earnings have to go before we start to see stabilization. In our coverage, close to 80 to 90% of technology companies will show a deceleration in growth in 2023. And tech stocks don't work in decelerating growth. And so we believe in the mullet trade, which is front half business, not really exciting, back half flowy, long, exciting. So we believe in the mullet trade. I think most of our clients are believing in the mullet trade, where it's kind of business in front, party in back. Hopefully that plays out. It may end up just being a dragged out, really tough 2023 is the risk. And it may end up being, a back half 24 reemergence from this rather than sometime in early next year. So again, I think the picture, at least from our economists, continues to get worse. I am listening to our internal economists because they have been in front of the puck on this, and I've listened to them, and it saved me from being too bullish. But tactically, I think there's only one way you can lean, which is when you have the CEO of the most admired company in tech, Microsoft, say it's 2 years before another tech inflection. That sums it up right there.
Yeah, you listen to him. I'm going to be waiting, Brent, for you to get the hairdo to match the strategy here. You need to do a little growing in the back. So, okay, business in the front, party in the back. What does that mean in terms of what companies fall into each of those categories?
So I think when you think about internet names have been hit the hardest because they are immediate revenue streams. You feel it. Like if you don't buy $400 Lego set, it shows up immediately in Amazon's numbers. It doesn't show up in Microsoft's numbers because they have recurring revenue that's on a subscription basis. It takes time for that to unwind. So I do think that some of the internet names are feeling it first, are probably going to trough first and probably come out of this. Semiconductors, our semi-analyst has been very clear that all the adoption from Meta around AI is going to benefit NVIDIA and other companies that are embedding in artificial and ML into their platforms. That will help NVIDIA. So our semi-analyst belief is that NVIDIA and some of these other names are probably at the front end, and they've had numerous number cuts. So perhaps semis and the internet will be the ones that come back first. I think software still has some lag because they have recurring contracts and it takes time for that to unwind before you see the weakness. And so I think we believe semis and internet may lead us out. Software will probably be a lagging indicator. We talk about black ice. We are obviously seeing black ice today in a lot of these tech names in the market today. So I'd say if you think about in the back half of the year, I think a lot of the small and mid cap software names will do very well. They're trading at a massive discount to M&A, Thoma Bravo, Vista. A number of the PE shops have been taking out companies at a 50%, 60, 70, 80% premium to where current stocks are trading now. So back half of the year, we believe will be good for small and mid. And I think for large cap, they're still unwinding. So I'm actually a little more bullish about small and mid. So are our strategists internally, Jeffries, around small and mid cap. They're coiled springs in the back half of the year. But again, I want to be very clear. I think the front half is going to be a lot of pain, and use an opportunity to buy into the pain, and potentially, again, I think for longer term holders, this is going to be a great recovery over the next 2 years. This year, again, we're kind of stuck in a swamp, if you will. There's going to be some pockets of up, but I don't see a great picture in the front half of the year. And it may continue, and we may end up coming back to you and saying, we don't see a great picture for all of 23, and it may really just end up being the party in the back with the mullet comes in 24.
Brian, you mentioned Microsoft CEO Satya Nadella in his latest warning this week. Well, does that make Microsoft shares dead money for the next 2 years?
It's the best house in a bad neighborhood. So I think the answer for largely tech, we're stuck in a tight trading range. To answer your question, we like Microsoft long term. We have a $270 price target. We think this is one of the best franchises, one of the best management teams, one of the most ethical, just upstanding. Again, I think Nadella wins the award for the most admired person in my industry. And so I go back to, you want a leader like him to lead through what's going on, and I have a huge admiration. I think, unfortunately, short term, a lot of these names are stuck. And if you believe in a $10 earnings number for Microsoft, it's hard to argue that you're going to put anything past a 25 multiple. That would be $250 in the stock. And so we think, again, Microsoft's stuck between a $200 to $250 range if you took a 20 to 25 multiple on earnings. And again, stock you're showing right now at 224. We're stuck right in the middle of that. So that would suggest, to your point, to answer your question, it's kind of stuck in the short term until we have a breakout on what's happening in the overall environment.
Yeah, I'm interested to see what Bing plus Chat GPT looks like, but that's a whole nother conversation. Brent Thill, thank you so much. It's good to see you. Sobering words, as you said, on what's going on in tech right now. Appreciate it. Elsewhere, though, outside of big tech, we're seeing actually big gains for one particular stock, Exponential Fitness. Those shares have risen over 80% since its IPO. They've actually risen in the last year as well, despite the broader market sell-off. Exponential Fitness CEO Anthony Geisler joins us now to discuss what to expect in 2023. Anthony, good to see you. Thank you for being here. I guess actually going to the gym and pumping some iron is working a little bit better than some of the big tech companies right now, which is an interesting place to be. As we get into this year, what is sort of going to be your main strategic goal for 2023?
I mean, we're going to continue to do what we've been doing. Q3 was amazing for us. Our revenues grew 56%. Our system-wide sales were up 37%. We did deals in Japan and Kuwait and Portugal, and did B2B, broader B2B deals with Princess and Active and Lululemon, and increased membership 33%. And now that allows us to raise guidance But, we sold 258 new franchises. We opened 128 new stores. We did 36 of those in the last week of the quarter. So, the AUVs are at an all-time high, our openings at an all-time high, our total store count at all-time highs. So, we're living off of some really great tailwinds in the fitness industry coming out of COVID, and a lot of our competitors closing during COVID. So we're comping almost twice as high, coming out of COVID as we were in a pre-COVID world.
Anthony, I went to my gym over the weekend and I saw 3 people in a Zumba class. And my first thought was, wow, what a fall from grace. As an owner of all these brands, how do you keep them hot?
I mean, look, what's so great is that we're a portfolio, right? And so, we're not worried about, all 10 flavors of ice cream that we're scooping being the hottest brand, right? And so for us, we look at it as a portfolio play. And so at certain points in time, cycling has been hotter. 20 plus years ago when I got started, cycling was hot, and then it was less hot, and then it got hotter again. And so what's so great about us is that, we kind of have that shared risk. But of course, we're the largest, franchisor doing what we do in boutique fitness. So we've got a lot of instructors across the country. And so we're continuing to make sure that everything is fresh and continue to make sure that, our portfolio has brands and modalities, in these new fresh, verticals.
Have you seen any weakness among the franchisees who are looking to expand the brands that you own even further into new categories or regions, rather?
Yeah, over 55% of our franchisees actually own multiple units, and then a lot own multiple brands. So we have some franchisees that own 3 or 4 locations that just sit side by side in the same shopping centers. And so they're able to actually share some instructors, share some front desk staff. About 85% of the backbone of each of the brands are exactly the same. And about 15%, we, celebrate the individuality of each of those brands. And so, it allows our franchisees to expand. For instance, our first Rumble Boxing, which is one of our hot new brands, opened in Anchorage, Alaska with one of our Pure Barre franchisees who's expanding. And so she's getting to enjoy, the expansion of the brands right alongside us.
Anthony, I'm a Rumble fan as well, but just to dig down into that a little bit more. So it sounds like you are still seeing expansion among the franchisees to opening other franchises. Have you seen a slowdown, though, at all in that expansion as we are seeing the economy slow down?
No, as I said earlier, we sold 258 franchises in Q3. And so we're continuing to sell internally and externally, welcoming new franchisees to the business. And so we'll sell, more franchises this year and open more stores than we ever have as a company. And so, we're not seeing any slowdown in, system-wide sales, kind of at the bottom consumer side. And we're not seeing at the top of the funnel where, franchisees come in to buy a franchise and continue to operate their units. And our franchisees buy an average of 3 units, and then they develop those 3 units over time. And so we're still seeing those openings happening. Like I said, our most openings we've ever done in company history was 36 in a week, and that happened in the last week of the quarter. So it couldn't be any more recent demand than that.
Are you looking at any new brands to add to the portfolio right now?
We always are. Like anything, I get a lot of really great phone calls and a lot of really not so great phone calls as people are out there, building their businesses and kind of, living their passion inside the fitness industry. And so we're always looking. We're looking to be opportunistic, and we'll continue to do that, as we go forward.
All right, we're going to be waiting with bated breath to see exactly which of those phone calls catches your interest too. Exponential Fitness CEO Anthony Geisler, always a pleasure to get some time with you.
Great, thank you guys. I appreciate the time as well.
Thanks. Coming up, a Tesla fan is taking trademark filing into his own hands. We're going to discuss exactly what's taking place there. That's next. Welcome back, everyone. Time for Cup of Time. You hear the story, you know what time it is. 3 stories, 1 minute each. We start with this on the day. An avid fan of Tesla decided to take a proactive approach to help the company by filing an application to extend the EV maker's trademark for use in boats and planes. This submission was made without Tesla's knowledge here. This one made it all the way into the U.S. Patent and Trademark Office. I mean, obviously, as it was registered. And it's basically saying that they're filing this for airplanes, for land, or anything not for land vehicles, permanent magnet motors, boat motors, drive systems. And so Tesla has now been made aware of this, and we'll see what action they take.
Are they going to just give it to Tesla? Is that the idea?
I don't believe they can just give it to Tesla.
I'm glad I filed this because I'm excited to see what's happening. But really, even outside the joke there, it's unlikely Tesla's getting the boats anytime. It can't even get the Cybertruck to market.
Or the ATVs.
Or the Semi.
Yeah. So
market, really, to any extent. The last thing they need to be doing is making electric boats.
No.
There we go. With the new year comes a new look for Hasbro's classic board game Clue. The newest edition features new art, miniatures, and elements into the original murder mystery storyline. After I realized I pitched it to the team to talk about in Cover Time, I've never actually played Clue, but I'm more of a Life or a Guess Who and a Mousetrap fan, but a very popular game, getting light updates inside of, ahead of after the holiday season, I should say, and a very important segment for Hasbro. They make a big money off of board games, one of their key businesses for them.
Have you ever seen the Clue movie?
I've not seen the Clue movie.
Fantastic. Yeah. Highly recommend. Maybe a cult classic from the 80s. I don't know if it was a cult classic, but it was really a really fun movie, actually. In the days before Glass Onion, all that stuff.
Yeah.
It was a fun movie.
Well, so that's
a movie based on a board game.
Right.
But it was really fun.
Well, so that's what I was going to mention, really capitalizing on the fanfare around some of the whodunit movies and titles right now, too. So perhaps timely for the revamp.
I love Clue.
I was more of a Monopoly and Life fan as well.
Yeah. What's the family board game for you guys? What's your go-to? Uno? Is it Uno?
There's one called Quirkle.
Quirkle.
Oh. Commerce technology company Boxed announcing it's launching a process to explore strategic alternatives, including a possible sale of the company. In addition, Boxed is actively exploring capital raising initiatives. It's a very, very small cap company. You see it's a 31-cent stock, but it's getting a big pop today on this news that it is effectively maybe putting itself up for sale.
It refused to be boxed into being a public company, Brad.
Well, they had done a lot of expansion trying to get more into the B2B category of that too, because it really is, if you think about buying in bulk and then just having it directly shipped to you instead of having a membership. Perhaps some of our viewers had used it in the past, but from the communications that I've had with the company, it sounds like they're continuing to fundraise, looking to boost capital, and they've retained a firm, an outside legal firm, to really explore this sale. And we'll see if they get any bidders to buy out Boxed.
Yeah, I think I see Quirkle on one of those boxes, Julie. Quirkle.
Could be.
Quirkle.
They do more of a grocery. They do more of a grocery business.
Grocery, okay.
But I think, right? It's more staples.
More of the staples, the toiletries, groceries. Yeah.
No Quirkle.
No, Quirkle. It's not. You guys always. I got my weird cereal. I got my weird
Quirkle Heritage
games.
Flakes.
I don't know. We also play something called Taco Cat Goat Cheese Pizza, which is a card game. That one's fun too. And like escape room games are big now too. You can do them at home. Okay. That's the toy report from Julie Diamond.
To each his or her own.
Yeah. Let's take a quick look at markets here before we leave you, because we are seeing all 3 markets in the red, even as we joke around here. Obviously, there's a lot of selling pressure going on today, particularly with big cap technology down 1.2% as measured by the Nasdaq. Coming up, Akiko Fujita and Rochelle Akuvo are going to speak with Greg Valliere about the latest updates over the battle for House Speaker. Bye, Saz.
Welcome to Yahoo Finance Live. It is 8 a.m. on the West Coast, 11 a.m. on the East. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. Groundhog Day. It may not be February 2nd yet, but it might be by the time we get a new House Speaker. Kevin McCarthy loses a 6th vote for the seat, now offering more concessions that would threaten the power of his gavel if he secures it. A deep cut. Amazon slashes the most jobs in its history, an 80% increase on the previous figure. But employees will have to wait almost 2 weeks to find out if their number is up. We're going to look at the wider impact on a troubled tech sector ahead. And still with us, concerns rising over a COVID variant moving at breakneck speed in the U.S. We're going to take a look at how much of a problem it could be and also assess Europe's fragmented response to any spread from China. First, though, let's take a look at major indices and how they are faring right now. You see it is red arrows across the board right now with the Dow down nearly 400 points, the S&P 500 down 43, the Nasdaq down 126. A lot of this coming through from those ADP payroll numbers, that private payroll numbers we got this morning, much stronger than expected, sort of feeding this concern that investors have had that the Fed's going to continue on its rate hike for longer than expected. Let's also do a quick check of Treasury yields right now, how they are faring there. Certainly tied to some of those results that we got this morning, too. The 10-year yield at 3.75%, up slightly there, and the 30-year yield up at 3.84%. We are beginning this hour, though, with what can only be described as chaos over in Washington. Kevin McCarthy's losing streak continues as he fails to win the votes for House Speaker yet again. Members of the House will reconvene an hour from now for a third day as McCarthy still holds out hope to step into the top job. And yes, Rochelle, we are now in day 3 of this. We've gone through 6 rounds of votes. McCarthy not able to secure the 218 that are needed to become the next House Speaker. We're talking about a 7th round here. Some interesting developments overnight, we should point out, that suggest significant concessions on the part of Kevin McCarthy that would really, if he becomes House Speaker, significantly reduce his power. There's a few things to note. That includes a change on a motion to vacate. McCarthy essentially lowering the threshold, allowing a single lawmaker to force a vote at any time to oust McCarthy himself as Speaker. He's also reportedly giving the House Freedom Caucus, the right-wing faction of the party, 2 seats on the powerful House Rules Committee. And then he's also made a commitment to vote on term limits. This is something that's been raised by Congressman Ralph Norman over in South Carolina. He wants a constitutional amendment that, if ratified, would limit those serving in the House to 3 term limits and those in the Senate to 2. And Rochelle, even with those concessions, there are still 5 Republican lawmakers who have said they are a hard no on McCarthy, and he can only afford to lose 4.
I mean, and it's true. When you think of all the power and all the concessions that he's now whittled away, and still you have some hardliners in the party who, no matter what it seems, no matter what the concessions or no matter what committees they tend to be put on, it's always going to be a no. And as we've been talking about, this is the first time in 100 years that it's gone beyond just one ballot. And as you mentioned, we're now going into the 7th. And when we look at some of the contenders, some of the names that are being mentioned, most of them are actually supporters of McCarthy. You have Scalise as a front runner. You have Jim Jordan's name being mentioned. You have also McHenry's name being mentioned, although he's perhaps got more of an eye on the Financial Services Committee. So even the people who want the role don't seem to have enough support either. And when you look at, obviously, the internet has been having a field day with this. Lots of jokes across the board and lots of memes. You know, the internet is merciless with this. We've seen not only Elon Musk weighing in saying, hey, look, you should pick McCarthy. You've also had Jon Stewart saying, look, this is like the best season of C-SPAN that we've seen so far. And even taking it all the way back to Sesame Street, we have The Count weighing in here. Now that we're at 6 different attempts at this for McCarthy, it is getting a little bit embarrassing. And people are going to wonder, will this continue? Once they pick a speaker, will we continue to see some of this dysfunction, or will they then all rally together? But that's something that we're not even going to know if we can't get past this first hurdle.
Yeah, I've heard a lot of C-SPAN references over the last few days, and I think my favorite there is on the Sesame Street tweet. All right, let's keep the conversation going here and bring in our first guest for the hour. We've got Greg Valliere. He's AGF Investments Chief U.S. Policy Strategist. Greg, I'm not going to have you make a prediction on how many rounds we're going to go here, but let's talk about the policy implications. How are you thinking about that as we now go on day 3 of this vote?
Well, they're not good on two levels. In the long term, as we get into the summer, we're going to be talking about a debt crisis, hitting the debt ceiling, maybe even a funding crisis for the U.S. debt. In the short run, what happens if California's rain continues and the floods require emergency aid? What happens if there's a foreign policy crisis that needs emergency aid? The House is totally frozen. They have the ability to do nothing right now. And this is really quite unprecedented.
And obviously, we're getting a lot of different people weighing in, even Lauren Boebert going against her favorite president, Donald Trump, saying, look, he should instead be backing McCarthy. He doesn't have enough votes. But when you do have so many hardliners in the party, are we going to see this then reflected in the policies as well?
And I might add, Rochelle, I think that as people desperately scramble for a fallback, the two that we're hearing the most are, number one, to take away most of Kevin McCarthy's power should he be elected, making it very easy to remove him. And secondly, is there a fallback in Steve Scalise? I think Scalise is a possibility. If McCarthy doesn't make any progress today, I think there's going to have to be a migration to someone like Scalise, who's pretty well liked among most all Republicans.
Is he somebody that can muster 218 votes, though?
Yeah, who knows? That's impossible. Maybe Rochelle has a better answer than me, but I mean, who knows if you can get that many votes? I think Scalise could come a little bit closer, but these five hard no's are going to be very, very difficult to overcome.
At what point do you think it's going to be a case where McCarthy just isn't going to be the one? I mean, even when you look at Scalise, some people are saying, look, he's too close in terms of being too similar to McCarthy. Yeah. So perhaps even he won't get that vote.
I think today is going to be pretty crucial. If it's the same 19 or 20 no's, I think you're going to have to start thinking about moving on. I guess the key would be whether moderate House Republicans, and there are some, would have anything to do with the concessions that were made overnight by McCarthy. My sense is that if McCarthy makes some progress with the hardliners, he's going to lose support among the moderates. So net, it's still hard to see how McCarthy pulls this out.
There are those lawmakers on the other side of the aisle, Greg, Democratic lawmakers sort of letting the show play out for now. They don't obviously have the majority in the House, which is why we're talking about a Republican House Speaker. But is there any leverage to be gained for Democrats from what's been playing out on the other side?
Well, the Democrats obviously have had a field day with this. You showed some of the texts that were pretty funny, but it's not funny. And I think as this drags on, I think more and more people in Washington will become exasperated with the inability of the Republicans to get their act together. I mean, it does help the Democrats politically. Most voters, perhaps in a year and a half, will have forgotten about it. But at the same time, if we have any kind of crisis, and I would put a debt default crisis high on that list, that would just exacerbate all of the anxiety that voters may eventually have.
And Greg, do you think there is going to be a tipping point where they're like, look, we just have to rally together, get a speaker in place and just move on so we can actually get to the business of actually creating policy?
Eventually, yes, but it's sort of like eventually we'll get a negotiations between Russia and Ukraine. There was some news on that this morning, but eventually has a long time frame, and I think that it's very unlikely we're going to get any kind of deal that would satisfy Kevin McCarthy. At some point, he's going to have to say, I gave it a good fight, but we're going to have to move on for the sake of the country. But I guess he's not there yet. But I think it's not that far away. I would guess it's probably a few days away, and they'll probably really carefully look at not just Scalise, but other members who could get that magical vote total.
We'll be keeping an eye on that when that kicks off again in about an hour. Thank you for joining us, Greg Valliere, AGF Investments Chief U.S. Policy Strategist. Thank you so much. Right, well, sticking with politics, we're focusing in on the latest efforts towards Biden's plan to cancel billions in federal student loans. We have Yahoo Finance's Jennifer Schonberger here with the details. Jennifer, a lot of back and forth on this. Where do things stand now?
Good morning to you. A lot of back and forth on this outside of the speaker race. The Justice Department filing a brief late Wednesday with the Supreme Court defending President Joe Biden's plan to cancel billions of dollars in federal student debt. The filing marks the beginning of a high-stakes battle where the conservative-led High Court will hear oral arguments in February in two cases challenging the student debt relief program, which provides up to $20,000 of loan forgiveness for millions of borrowers. The Biden administration is defending its policy after two parties are challenging it. One case is a lawsuit by 6 Republican-led states led by Nebraska and Missouri. The second was brought by 2 Texas student loan borrowers who were partially or fully excluded from the program. Now, the administration argues the Supreme Court should toss out the case because Republican states and Texas borrowers lack legal standing to bring the case. The Justice Department also argues Education Secretary Miguel Cardona had clear authority to provide debt relief to borrowers under the Higher Education Relief Opportunities Act, which gives the Education Department the power to waive the laws that typically govern federal student loans during national emergencies. The filing notes that, quote, ending that pause without providing some additional relief for lower income borrowers would cause delinquency and default rates to spike above pre-pandemic levels. This court should not compel that damaging and destabilizing result. Now, the cost of a public 4-year college has rocketed nearly 160% in the past 30 years. Some numbers here from the Fed and the College Board noting that each borrower on average owes nearly $30,000, and 55% of students from public 4-year institutions had federal student loans. Federal student loan payments have been paused since March 2020, with the majority of those in forbearance now. Rochelle?
So, Jen, let's pick up on that point. I mean, what happens if, in fact, the Biden administration loses the Supreme Court case? What happens to the payment pause? Because the restart date hasn't really been determined yet.
Right, exactly. That's been held up in lower courts, which the Biden administration is trying to defend their point, saying that, you know, we're going to see a lot of destabilizing effects there. And if this, remember, this is a Supreme Court that is led 6-3 by conservatives. So there may be a bias towards some of these more conservative held views led by the Republican-led states, led by Texas. And so there is a very real risk that this could be turned over. We'll see how things play out. We won't probably get a decision from the oral arguments, which are due in February, until June. So we'll probably be in a holding pattern here for the first half of this year.
Yeah, no question. A lot at stake with that Supreme Court case. Jen Schomburger, thanks so much for bringing us that story. Well, shares of Bed Bath & Beyond are hitting a new 52-week low today. Take a look at that stock, down 24%. The company warning on Thursday it is now considering bankruptcy as it burns through its cash pile. Bed Bath CEO Sue Gove citing a number of challenges the company faces, including its inability to secure enough merchandise to fill those store shelves. It's also struggled to attract customers to its stores and website. The company says it is now exploring a slew of options, including restructuring and selling some of its assets. That's in addition to bankruptcy. Bed Bath has been weighed down by its piling debt load, with unsecured notes totaling nearly $2.1 billion. Well, coming up, taking on Tesla's Sony Honda Mobility throws its hat in the ring with the Afeela. So as Elon Musk's competitors circle the wagons, we ask, have we hit EV saturation? Dan Halley will have the coverage for us on the other side. Welcome back to Yahoo Finance Live, where we are back for day 2 over at the Consumer Electronics Show, the Las Vegas show. Yearly convention is underway, but with major tech companies holding their own events like WWDC and Google I/O, the convention's increasingly serving up new tech-focused cars. Joining us with the latest, we've got Yahoo Finance's Dan Howley. Dan, this is one of those transitions that we've seen evolve over the last few years in terms of the focus of CES. Increasingly, a lot of focus on mobility. What are you seeing on the ground there?
That's right, Akiko. We've seen CES turn into basically a car show. There's an entire West Hall, which is where we are. It's covered with cars, car companies as far as the eye can see. I think one of the most interesting announcements, though, came last night from Sony Honda Mobility. That's the new company that is Sony and Honda's team up to make an electric car. Sony's kind of leading the way here with Honda doing the manufacturing. And let me just give you a rundown of what this car has to offer. They're going with kind of a minimalist design, they say, to really focus on the driver. But as you walk up to the car, the front has kind of a media bar that can tell you things like the car's charging status as well as the weather, because sure, why not? You are walking outside to a car, you know what the weather's like really, but maybe also reading it helps. On the inside, there's a panoramic infotainment center that runs the entire width of the windshield. So it's going to be from the driver's side to the passenger side, all one infotainment system. It has 45 different cameras and sensors. This is really supposed to be a level 3 autonomous car. So that means that it'll be able to drive in some urban settings, which is pretty difficult for autonomous vehicles, but it doesn't mean that it can drive on its own. This is something that you're still going to need to grab the wheel on if the car tells you. The full autonomous is considered level 5. That's still years and years away. It doesn't matter what anyone else is saying. It's still very far off in the distant future. But this is meant to be a platform for Sony's entertainment options, whether that's video, whether that's video games, whether that's music. And that's the deal here, is that they want to kind of push that forward in the vehicle and produce their own kind of car. Now, when does this go on sale? Pre-orders start in 2025, the early half of 2025. It actually goes on sale in the end of 2025, and then it'll start hitting the road in 2026. So we still have some time ahead before the actual FILA is what they're calling it, the FILA, feel, because feeling things is what Sony wants you to do with the car. But yes, it'll take about 3 years now for it to officially be on the road.
And it's interesting because when you think of traditional car shows and then you saw this push more for CES, as you saw this cross-pollination between chip makers and high-tech and cars now, this does seem to be the way forward. What sort of standouts are you looking at for the show?
Yeah, I think, we had BMW show off their wild new concept car. We have Stellantis showing off a new Ram, as well as they have their electric charger here. I got to get a close look on that. No keys around, so I couldn't take off with it, but, I'll find a way. We have Mercedes behind us, and then we have some other kind of gaming-related news with cars. NVIDIA, believe it or not, is working with the likes of Hyundai, BYD, and Polestar to make it so that its GeForce Cloud gaming platform works in those cars. So when you're parked, you'll be able to play video games on your infotainment center directly in front of you, whether you're the driver's side or the passenger side. And then passengers in the rear, if there's a TV available in the back of the car, they'll be able to play as well. So we're seeing all this technology filter into vehicles that you might not have otherwise thought for some time. Look, this is my, I think, 11th CES. I've seen cars kind of trickle in, but now, as you said, this is really where the technology and the vehicles meet. Qualcomm's working with Sony, we have NVIDIA working with other automakers. You name it, companies are working together to get more tech into cars, and we're just starting to scratch the surface here at CES 2023.
Certainly full sensory overload now inside these cars. A big thank you to Dan Howley there, live from Vegas at CES. Well, away from the glitz and glamour of CES, semiconductor makers are bracing for chip market carnage. Reports surfacing that Samsung could be taking a beating from falling chip demand as supply chains untangle and consumer demand eases up. Memory prices are a key area of focus and, of course, are critical to the South Korean giant's bottom line. Meanwhile, a report from Bloomberg indicating that China might be putting on hold plans to invest in its domestic semiconductor industry. Now, we know that this was a big announcement that China made with this attempt to sort of rival what we saw with the US chip industry. But now when we look at things like subsidies, when we look at the cost that zero COVID has had on the economy, now instead focusing on homegrown chip makers instead of now trying to rival the US and others.
Yeah, we should point out this is a report from Bloomberg that's out there, not an official policy that's come out of China. But it is worth noting when you think about where that focus has been, to your point, Rochelle, it has been about huge incentives for these homegrown chip makers. That hasn't necessarily borne fruit in terms of their ability to compete on an international level. And so this report from Bloomberg essentially suggesting, maybe there are other ways that the Chinese government, from a domestic standpoint, can support their players, including potentially bringing down some of the costs of materials for those chips. At the end of the day, though, I mean, China as well as the U.S., because we have sort of framed this in a two-track competition sort of set. And at the end of the day, it is about China wanting to compete with the U.S. economically as well as from militarily, with the chip sector really at the core of it. So it's going to be interesting to see how that all pans out. But Samsung report there, kind of interesting to me, Rochelle, because it does jive with what we've heard from other semiconductor companies who've said that the demand, especially in PC sales, that's really dropped off. And when you think about where Samsung makes 50% of its profit, it is in NAND and DRAM chips. And that's where they go in. And that sort of points to kind of the slowdown that we've seen in the chip sector.
And you have these companies really essentially caught in the middle. You have the Nikkei reporting that Dell plans to stop using China-made chips by 2024, telling suppliers also that other made-in-China components are going to be pulling back on that because they're really stuck in the middle of what's happening between Washington and Beijing. And then we also saw that former Samsung executive turned lawmaker, Yang Jianke, said we're in a chip war. They're really stuck in the middle here between the US and China, saying that the technology supremacy is a way that our country can take the lead in any security-related agenda, such as diplomatic and defense issues, without being swayed by other nations. So even beyond the chips themselves and really trying to grow their economies, there's also this political push and pull for some of these countries and companies stuck in the middle as well.
Yeah, I mean, that's something that we've talked about, right? Where the U.S. is coming out very hardline against China and those chips. Where do these countries fall? A country like Japan, for example, has really sort of at least publicly made it clear that they will fall in line with Japan, with the U.S. But South Korea has been a little more hesitant, largely because their biggest player, Samsung, is one of the biggest players in terms of chip making globally. But it is going to be interesting to see at the end of the day, where things fall, because the U.S., maybe not explicitly, has said that they believe that these countries need to pick sides at some point.
It's true. We're certainly seeing those allegiances start to take a bit more shape as this develops. All right, well, coming up, a deep cut. Amazon expands layoffs to 18,000 workers, outstripping even Meta staff reductions. We look at where the biggest cuts in the group's history will fall next. Amazon will expand its planned job cuts to 18,000 workers, the biggest layoffs in its history. Now, CEO Andy Jassy said the move would impact Amazon stores and the group's people experience and tech solutions divisions. Now, for many employees, the next few weeks will be excruciating as they won't find out if they've been laid off until January 18th. So, I mean, a lot of people were shocked that this was perhaps an even greater set of layoffs than expected. We know that a lot of tech companies have been having layoffs, overhired too much during the pandemic without really sort of thinking what the long-term vision would be, but much more than expected here.
Yeah, Andy Jassy saying in a letter to employees that essentially companies that last a long time go through different phases. They're not in heavy people expansion mode every year. But in many ways, this is kind of a similar story that we've heard from so many other tech companies. It is that we grew too quickly during the pandemic. Now there is a whiplash happening in the other direction where they're having to cut costs, especially in the face of an uncertain economic environment. Amazon obviously getting a lot of criticism, largely because Andy Jassy is still relatively new in this role. And the question, I think, internally could be then become, well, can he like Jeff Bezos, be able to navigate some of these headwinds? I thought it was some interesting commentary this morning, though, Rochelle. Brent Thill from Jefferies on our morning show saying that the pandemic created a type of bubble for these tech companies, that things grew too quickly. We have heard this over and over. We hired too many people. We expanded too quickly. And now you're seeing the reckoning on the other end. And he says specifically that he doesn't think there's going to be a real turnaround until 2024, and that 80 to 90% of tech companies will show decelerated growth this year. And you see all the names on the screen right there. This is not an Amazon-specific story, although 18,000 is a significant number in terms of tech companies really looking at their balance sheets and say, we're going to have to shrink a little more. We're going to have to be a little more cost efficient because the economics just don't look good right now, and there's a lot of uncertainty.
I mean, even when you think of within the companies themselves, you have the broader tech sell-off that we've seen, but also within the companies, their individual problems, growing too fast. Perhaps also as we look at the case of Amazon, this e-commerce boom, yes, it was of course going to boom during the pandemic, but what was going to happen afterwards? There was going to be some sort of normalcy, some sort of leveling off. And there are a lot more players in this space now. You have your Walmarts taking some of their market share as well. So you figured at some point there was going to be a sort of leveling off. But as we look at individual stories, for example, when you think of Tesla and the issues with Twitter, each has their own sort of individual problems that are just compounding the broader tech sell-off at the moment.
It is also about companies really having to find their focus. I mean, you talked about e-commerce with Amazon. That's certainly been slowing down. We've seen that reflected in their earnings. But when you think about this letter that Andy Jassy has put out, you know, where they're actually making the cuts, it is about the company doubling down on things that have been really working for them. Obviously, cloud and AWS continue to be a big driver for them. You look at some other companies like Salesforce yesterday coming out and they're going to be cutting 10% of their workforce. So we're increasingly hearing from these companies, not just about the growth that they saw, the outsized growth, I should say, they saw over the last few years, but also the need to focus a little more, not dabble in loss-making ventures, but also really focus on where the revenue drivers are and really be profitable. At the end of the day, it's not growth at all costs anymore. It is about profitability. And for these publicly traded companies, that is number one in terms of what investors are looking at.
It's true. And it is worth noting that these layoffs represent 1.2% of their entire workforce. So some context there. Just obviously, it's a lot of people, still obviously 18,000. But when you think of the size of an Amazon, worth keeping that in mind as well. All right, coming up, seeing value in value. Goldman Sachs says these are the stocks to keep your eye on amid an exodus in tech shares. But is that really the trajectory? We'll take a look closer at the markets next. Value stocks may be looking at another year ahead of outperforming growth stocks as central banks keep interest rates elevated and with the tech sector under pressure. For more on this, we have Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, and it's worth noting that higher interest rates make future cash flows less valuable. And so we saw in 2022, amid a higher interest rate environment, that growth stocks, big tech stocks, really took a hit. Amid that higher interest rate environment, you've got a slowing economy, you've got margin pressures as well. So this all makes less valuable stocks more in vogue, in favor. So we saw value stocks really in favor in 2022. Well, that's a trend that's expected to continue, according to Goldman strategists. They see value stocks outperforming again in 2023. Goldman says that growth and tech is still expensive, even after falling last year. Remember that tech and other growth stocks, those were the leaders when it came to the worst sell-off last year since 2008. So strategists at Goldman that are led by Peter Oppenheimer, the strategist, said that as big cap technology sees further margin pressures and commodity prices rise and real interest rates remain higher, we think that it's a trend that's going to continue. So they're not the only ones that are saying this. A Bank of America note this week said that investors should avoid crowded spaces, including big tech. You also had a note from Morgan Stanley with the strategist Michael Wilson warning about profit margins at tech companies being under pressure. So what is in favor? Well, this year, financials and energy stocks. Now, can energy stocks really perform their spectacular performance that they had last year, this year again? Can they do that again? Well, I had spoken to strategists about this, and that's in a recent note that I put on Yahoo Finance. Maybe they won't repeat the exact spectacular performance that they had last year, but they are expected to do well again this year, guys.
Yeah, it's hard to top 2022 when you think about where energy traded over the last year. We'll continue to watch that. Inez, thanks so much for that. Well, Disney, Warner Brothers, Discovery, Paramount, and Fox all hit with price target cuts by Macquarie as media stocks face some turbulence in 2023 with a weakening advertising market. Here to discuss, we have Tim Nolan, Macquarie's senior media tech analyst. Tim, good to talk to you this morning. I realize all these companies have their own narratives going, but I'm curious if we can start on the demand picture, because we have heard this over and over, questions about reaching a saturation point. Are we continuing to see the demand for this type of content, even if consumers are saying, I'm willing to go with the cheaper ad-supported tier?
Yeah, I think demand is still high, but there's so much competition now. You know, we've been talking about the streaming wars for 2 or 3 years already now. All of the major TV network groups have shifted toward direct-to-consumer streaming, and a lot of them are going after that same audience. So in a slowing economy, you know, consumers are looking at their wallets and they're choosing to be more selective in which subscription services they are paying for. So you get this sort of constant churn on and off different services as you watch one show on Netflix, drop that, watch a show on Amazon Prime, drop that, etc. So it's a much more competitive landscape. It doesn't mean the demand is going down. I just think there's so much more availability of programming now. Consumers have just been spoiled for choice. And now they're just going to be looking at more carefully at what they choose to pay for.
And unlike Netflix, if you're a Disney or an Amazon, you have other business entities that you can rely on, you know, under your umbrella then. So let's start with Disney then. In terms of Bob Iger's return, how much of a difference do you think that's going to make to Disney's story?
Yeah, well, we've thought for a long time that Disney will, and it's certainly proven to be the case, be one of the winners in this whole multi-year transition from traditional linear TV viewership to streaming. I mean, Disney has obviously the brand presence globally. They've got the depth of content. They've got all of the, you know, popular content still being, you know, introduced in new forms. So new Star Wars series, new Marvel series, et cetera, on the streaming platform. So we think the opportunity is vast for Disney, and they've certainly demonstrated that thus far. They have, as all of their peers have, invested very, very heavily in the content base. And that's just been a necessity given the competition. In Disney's case, it looks like calendar year 22 might have been the worst of times in terms of the operating performance of the streaming service. they've signaled quite strong that they intend to get that service toward profitability over the next 8 quarters, so sometime during fiscal year 24. So as soon as 4 to 6 quarters from now, you could have the DTC, the direct-to-consumer streaming services, which is Disney Plus, Hulu, and ESPN Plus, moving into at least break-even status in the next year and a half or so. That would be taken very, very positively, I think, by investors. And it hopefully will be a stepwise trend to get to that. Now, what Bob Iger brings coming back to Disney is, hopefully the investors are certainly hoping more of that magic that he brought over so many years. The employee relations, the external communications, the fans. I don't know if there are major strategic shifts coming, but if he can just bring that magic touch back to Disney, I think the stock can rebound.
And Tim, you've highlighted in terms of revenue drivers for Disney Plus, that ad-supported tier that was launched last year could be a big revenue driver in the amount of $800 million. But I'm more curious about the two overhangs we always talk about when it comes to Disney. It's the future of Hulu, but also ESPN. Increasingly, a lot of analysts who've pointed to the fact that they believe ESPN could be spun off. Is that a move that would make sense for you?
Yeah, it's been a topic of debate for some time. I think Disney sees great value in ESPN and is trying to find a way to move that into a fully over-the-top streaming service. Now, this has been a big discussion point for a long time, and it's very contentious because, as we've discussed for many years, that could be the move that really breaks the pay TV bundle. If you can get ESPN completely over the top without subscribing to a pay TV service, then why would you have pay TV at all? And so it's a huge change that is going to come eventually. And one of the things we're wondering is if this is maybe the biggest issue that Bob Iger will have to wrestle with during his Act 2 here at Disney. It's a tough question because there is a lot of money still being made on the linear bundle side. For all the talk about cord cutting and the declines there, the operating margins are still high, so it's very cash generative. Now, one catalyst for this move could be the upcoming NBA rights renewal. The new contract is due to start in 2025, so there's a few years to go. But these negotiations usually take place a couple of years beforehand. So it could very well be that 2023 is the year that the NBA is negotiating with ESPN and with Turner Networks over at Warner Brothers Discovery to actually renew this contract. There'll be a big price increase. And my estimate is ESPN can handle that if they can wrap in a lot more streaming availability of that content. So it could be an important step toward getting ESPN to a completely over-the-top service.
Yeah, really fascinating to see some of those negotiations play out there. Tim Nullen, Macquarie Senior Media Tech Analyst, appreciate your time. Well, coming up, it's 2023, but we haven't escaped the jaws of COVID just yet. We're going to take a look at a troubling new variant in the U.S. and how coordinated policy around China could be tricky for the EU. That's up next. Welcome back to Yahoo Finance Live. Well, concern is rising over a new COVID subvariant, which is fast becoming the dominant strain in the U.S., accounting for more than 40% of cases. This, at least according to the CDC. Let's bring in Yahoo Finance's Anjali Kamlani, who has the details. Anjali, how is this strain different from some of the others that we've seen before?
Well, let's start with what is similar about it. It is an Omicron subvariant, and that's really important to understand what we're looking at right now. So it is a different variant in the sense that it's highly transmissible. That's what's causing concerns, as you can tell, growing to 40% of cases in the past few weeks and really quickly spreading throughout the U.S. This is one of the variants that has been found in the U.S. first. So, it's been nicknamed the U.S. variant as well as Kraken. We do know that it isn't necessarily slated to be more severe than some of the other variants because Omicron in and of itself, that family, that lineage of the variants hasn't been very severe, in part because we have immunity built up over vaccinations as well as prior infection here in the U.S. But it is sort of a wait and see situation when it comes to what else we're expecting out of it. Still very new when it comes to what we know about this variant. Meanwhile, we know that it is part of the XBB family, which is, has been seen overseas as well and has been causing some rise in cases. But also we're in a situation right now in the world rather, where there is just a lot of difference in what each country is seeing. But it is so much of a concern that the World Health Organization did talk about it recently. Take a listen to what one of the experts had to say.
It does have a growth advantage above all of the other subvariants so far. We don't have any data on severity yet or on the clinical picture, but we also do not have an indication that severity has changed with XBB.1.5. But that is something that we are watching very closely through studies and with experimental studies in the lab, but also in real world data.
So as you can see, still looking at more information, but as things stand right now, just a really important, concerning variant to keep an eye on right now.
And of course, we have been keeping an eye on what's been happening with China as it reduced its zero COVID policy. And we're watching also a somewhat fragmented response in the European Union to China's COVID wave. What's the latest there?
That's right, Rochelle. So we know that Italy was one of the first of the European countries to put in restrictions that inbound Chinese travelers, regardless of citizenship status, would have to get a COVID test and make sure they had a negative COVID test upon arrival. Now that has been, Italy has been pleading with these other countries to also follow suit. And yesterday there was a meeting in which a majority seemed to be on board with the idea that inbound Chinese travelers will need to at the least test negative for COVID. This is causing, of course, a little bit of consternation. China pushing back, saying that they do not want to see any of these restrictions put in place, especially as the country has just come off of a zero COVID policy and finally releasing some of the stricter mitigation measures that they have had in place. Of course, in the U.S. as well, that policy was put in place on the inbound testing. And it's something that experts on the ground have kind of criticized. If you take a look at what we have on the ground here, no other additional measures to help curb the spread. So the question is, what good will these tests do? Well, the answer is in China's not reporting and stopping reporting cases publicly for the world to know what the situation is on the ground. And so that's really the driver behind why these testing measures are being put in place globally.
Certainly that transparency key at a time like this when we're trying to get a handle on the numbers out there. Anjali Kamlani, thank you so much. Well, in China, COVID continues to be a leading cause of concern for investors and for others who feel its data does not give an accurate picture of the situation. Here's what the World Health Organization's Emergencies Program Director had to say.
We know there are difficulties in all countries very often in recording hospital-related admissions and use of ICU facilities. But again, we believe that the current numbers being published from China underrepresent the true impact of the disease in terms of hospital admissions, in terms of ICU admissions, and particularly in terms of deaths.
Well, here to weigh in on that and the outlook for the pharmaceutical industry is BofA Global Research's Senior Pharmacy Analyst, Jeff Meacham. Jeff, good to have you on the show. So I first want to get your take on how you think the situation coming out of China is being handled by, say, the US and by the EU as well.
Yeah, it's a great question, and thank you for having me. For the most part, I would say, it's difficult for the companies that we follow in the pharma space. to really manage the situation in China, other than just to provide enough supply. So vaccines and orals, for example, Pfizer's Paxlovid and Moderna and Pfizer's vaccines as well. So there hasn't really been a supply constraint there. I would say China has purchased incremental amounts of the COVID therapies, but not anywhere near like what we're seeing from the infection rates. And so that's a big thing to watch in the next 6 months.
Yeah, I mean, how big of a catalyst do you think that can be when you look at some of the big biopharma names? We think back to the height of the pandemic, how well a Moderna or a Pfizer did. When you think about the needs over in China, do you see that as a significant catalyst for these companies?
I don't really from an investor perspective. And I say that because, 2020, 2021 were years of, sort of 2 years of a windfall, really, for the Pfizers and Modernas of the world. Also, Lilly benefited, Regeneron, companies that have, any sort of product for COVID, be it antibody or vaccine. But I would say last year, the numbers started to come down a little bit. And then 23 and beyond are really years where we're not expecting, a big uptake. And so if stocks move on let's say temporary Chinese demand, the thought is that may not have, the durability that people really expected prior to the beginning of the pandemic.
And we know that BofA downgraded Pfizer to neutral from buy, partly because obviously that the heydays of the pandemic, at least in the US and for most of the world, is behind us. And you also said they're continuing to enter increasingly crowded markets as well. Where does the growth story for Pfizer then go from here?
Yeah, it's a good question. There are a number of really exciting products that they have, coming out. So, if for migraine, for example, for some GI diseases like ulcerative colitis, some inflammation broadly, hematology, oncology. So these things they're all new products. They have some sort of differentiation, or they could be launching, in the next, say, 6 to 12 months. The issue is that, they're just not going to be big enough to move the needle for a top line that Pfizer has. And you have at the same time, COVID contracting this year and next year. So, it's we're not saying that, it won't happen, but I think these new launches and these new products are not really going to build momentum, I think, until, say 3-4 years from now. And that'll be about the same time frame that Pfizer is going to face some big patent expiries. So we're not negative on it. We're just saying, maybe better places to put money for this year.
Yeah, Jeff, you mentioned COVID contracting. Obviously, the strains are still there, but not at the level that we saw over the last few years. With that in mind, what are some of the big biotech, biopharma names you're especially bullish on, given the pipeline?
Yep. Yeah, so there's a couple that we like in the biotech space. So Vertex is one of them. The very very rapidly growing CF business, cystic fibrosis is their core franchise. But they have an encore to that with, a sickle cell drug, maybe launching end of this year, and perhaps a pain drug, which could be de-risked in the next couple of quarter or two. The other one we like is BioMarin, more of a rare disease kind of orphan drug company. A very stable base of growing, rare disease assets. But the big one is Roctavian, which is a gene therapy, cell therapy for hemophilia. It's approved in Europe, but could be approved in the U.S. in the next couple of months, and that would really start to, drive top line and really the adoption there has a lot of runway to it. Obviously, post approval.
We'll certainly be keeping an eye also on M&A in the space as well. BofA Senior Pharma Analyst Jeff Meacham, thank you for joining us this morning.
Thank you.
All right, coming up, we'll do a final check of the markets. That's next.
Let's do a final check of the markets before we let you go. As we head into the noon hour, the sell-off continuing with the Dow down more than 400 points, the S&P 500 down 43, and the Nasdaq down 114. A lot of this, Rochelle, coming through from those ADP private payroll numbers that we got this morning. 235,000 jobs added for the month. That is well above the 153,000 that was estimated. Certainly tomorrow, the big number coming on non-farm payrolls, but investors looking at that number saying, well, the labor market simply hasn't cooled down enough to the point where the Fed is able to take the foot off the pedal. And so that appears to be some concerns there. But service providers making up a big chunk of those jobs, at least in private payrolls that were added.
And that ADP data, they're building on what we heard from the FOMC minutes. They're talking about the Fed observing an unwarranted easing in financial conditions, basically still looking at that sticky labor market, still trying to get to that 2% inflation target, wondering why the market seems to be getting ahead of itself. So it's trying to throw some cold water, and certainly this ADP data doing that as well. Well, that'll do it for us for now. I'm Rochelle Akufo along with Akiko Fujita. We'll be back tomorrow. Thank you for watching.